I think the Fed is very aware that the U.S. economy is already showing signs of easing, that we're already seeing cracks in the armor.
Companies are still able to pass costs through. But again, as we reach higher and higher price levels, that becomes more difficult.
There's this frustration with where policy is headed.
Tightening will get us down to about a 4%, but getting down to a 3% probably is going to engineer a recession.
The reality is, I don't think they're going to be able to raise as much as markets have priced in.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Futures just about positive, 0.1%. TK, goodbye May. Hello, June.
Hello, June. It's almost like a mid-year review, John. There's been so much turmoil and tumult. I'm almost looking at June 1 as July 1, where you reset for the rest of the year. I mean, you know, you got a negative 1% 12-month trailing SPX. We're down year to date a little more than that. But just with the news flow we have, political and financial, is this our mid-year day?
Hey, Tom, let's talk about that. A mid-year review in the White House. What do you make of what's happening in the last couple of days?
I think there's a lot of jockeying going on. Greg Villiers with a smart note, others as well, talking about, you know, you change the guards. If you're a one-term presidency, what do you do mid-year? What do you do mid along the way? And maybe some bodies will move in and out.
Bremo, the effort to sharpen the message, an op-ed in the Wall Street Journal on inflation,
that worked.
In the New York Times on foreign policy, a mea culpa from Secretary Yellen.
Exactly.
And it's them, not us, towards the Federal Reserve on inflation.
I don't know that this really comes to a cohesive message. There also is a proposal for $2 billion to support the food supply chain. How much is too late, and how do they get ahead of a message that's changing in real time, that when they're already so far behind, it is unclear to see how they can potentially position themselves going forward?
TK, are you laser focused on the potential for a shake-up in that White House, given the NBC report that many people read about? Perhaps the president's upset about what's happening within his government, within his administration.
It's very typical, John. I mean, we see this among all administrations. I mean, it's part of the political process, if you will. What I would say, John, is how does it redound back to the Bloomberg world of economics, finance, investment? Chairman Powell, I believe his job is something that will stay. But you really wonder about Secretary Yellen and if there would be a switch there.
And the calendar going forward through this summer. Lisa, June 15th, the Fed. July 27th, the Fed. September 21, the Fed, and some CPI reports in between.
Yeah, and frankly, the price of gas at the pump may be the most important data point of all. How do they actually affect all of these economic indicators and, frankly, sentiment of consumer with trying to hone the message when you have a real issue, right? I mean, there's one thing if it's all a political drama. This is not political drama. This is real drama when people go to the store, when they go to the gas pump. And I think that they're going to have to deal with that. That's way beyond a messaging issue.
Speaking of drama, did you see the monthly performance of the S&P 500 through May?
Yes.
Just how it closed. Positive 0.01%.
Nothing happened.
It didn't feel like a positive 0.01% month, did it?
But if you look under the surface, there is still the turmoil. And actually, that's what's notable today. You're seeing a downgrade to some of the projections for big tech from Morgan Stanley. Even Citigroup is saying this is a bear market rally. There's a feeling that earnings per share, that basically valuations still need to make an adjustment in a new era of slower growth, higher inflation, and perhaps much higher interest rates.
Let's get June started. Futures positive on the S&P 500 this morning. Good morning to you all. Up about 0.11%. Looking at the Nasdaq 100 positive. They're negative, down by 0.11%. Yields look like this on a 10-year, up about a basis point, 285.86 on a 10-year yield. In foreign exchange, euro dollar basically unchanged, 107.28. And crude, Bramo. Crude was interesting yesterday. I'll allow you to explain that. But right now, 116.77, up by 1.8%.
Yeah, it closed down on the day. And this was interesting after a report in the Wall Street Journal talking about how Russia might be kicked out of the OPEC agreement or exempted from increasing production because, frankly, that production is not going to come online, which would basically pave the way for other oil-producing nations to increase production materially. All right, this is what I'm watching today. As Kaylee was talking about earlier, the Fed is formally kicking off quantitative tightening, although technically it doesn't really begin until June 15th, when $15 billion of treasuries come due. How quickly are they going to reduce their balance sheet what will the actual impact be? This is the big unknown in markets. This is what people are trying to price in. We've had a number of Fed officials come out and say it's basically the equivalent of a couple of 25 basis point rate hikes. It is not exactly the same. People are trying to price this in and really view this as a big unknown. At 10 a.m., the Bank of Canada is poised for its second consecutive 50 basis point hike. The reason why I'm watching this is because, frankly, the Bank of Canada has been out front. We don't talk about the Bank of Canada, but it really has been one of the more aggressive banks, and it sets the tone for how aggressive potentially the Federal Reserve and the ECB could potentially be. And today we get a host of Fed speak, including New York Fed President John Williams at 11:30, St. Louis Fed President Jim Bullard at 1 p.m. Also, the former New York Fed President Bill Dudley is joining us here on Bloomberg Television at 7:45 a.m. This comes after ISM data, as well as the JOLTS data, the job openings data that we get today. John, to really give an indication of just how frothy the labor market is and whether it's starting to cool, maybe a little bit, and giving them perhaps an exit ramp that's a little smoother.
Lisa, do you get the sense that the JOLTS data is a target? That data point is a target for this Federal Reserve?
Look, Fed Chair Jay Powell has pinpointed this particular data point as indicating perhaps how tight the labor market is. You can also just view any of the help wanted signs in any of the stores that you go into. Yes, I do think that this is important. However, it is backward looking. So this is something, how do they message this going forward will really give you a sense of where the Fed presidents are looking in terms of the path of the Fed funds rate.
Lisa, thank you. What a day ahead, what a week ahead going into payrolls this Friday. Joining us now to kick off coverage this morning, Vasilios Giannakis, the head of European FX strategy at Citi. Vasilios, your colleague Jamie Fahy said yields haven't peaked, equities haven't bottomed, the dollar is not out. On the third piece of that, where are you on the team on the dollar?
I think we largely agree with that, Jonathan. I think we have, first of all, a tactical view for a continuation of the dollar correction. It has happened before whenever we have been in dollar bull markets, in dollar rallies. We have seen periods at which we have been through dollar corrections. The dollar is overvalued. Of course, there will be periods at which markets will pay attention to it, but there will also be extended periods at which the market can stay irrational for longer than one can actually stay solvent. I think right now, for the immediate future, an important part of the key of the puzzle is actually China reopening. Now, with firms in Shanghai, manufacturing firms basically allowed to reopen from today, with COVID cases having come down quite considerably on the back of the lockdown, of course, there is a sense that we may get some impetus about this China reopening. And I think this is important because you can actually get the dollar correcting lower, even if US yields go higher. But the condition for that would be if growth expectations remain higher. And China reopening could actually play a role into that.
Right.
That being said, going further out, the dollar remains probably the best house in a bad neighborhood, meaning that there is still a fundamental story to support it.
Vasilios, the yen in the last 4 days is at a life of its own. What are the ramifications to the general currency markets if we get weak yen through 132?
Well, I think that has largely been, first of all, this has largely been a result of bottoming out, at least for now, in US yields that have propelled dollar-yen higher. And that, in a sense, is creating a bit of an issue as far as Japan is concerned, especially for the Ministry of Finance, because they are the ones really that have been pushing back a bit, at least, against further yen weakness. But it also, as you said, it is going to make an issue for the rest of the regional currencies because they're going to become less competitive. And of course, that includes the renminbi, as well as main competitors, including South Korea and other Asian currencies. It also implies that imports to Japan are going to be far more expensive, which also going to be implying that a lot of these exporters, the Asian exporters, are going to have a bit more difficulty pushing into the product chain towards Japan. So there is definitely an element of that. I wouldn't say that going from 127 to 132 is going to have a major impact of that.
Right.
I would be especially more concerned if we gravitate towards the 135, 140, which would definitely require US yields to go closer to 3.5%.
Vasilios, wonderful to get your thoughts on a show, as always, buddy. Vasilios Giannakis there of Citi on the FX market. Deutsche Bank out with a big call coming into this morning. Bram, I know you saw this one. Here's the quote. The burden of proof has shifted further and the data over the summer now needs to disprove the case for a 50 basis point hike early in this hiking cycle. We're not talking about the Fed. We're talking about the ECB. They go on to say our previous baseline was to expect back-to-back 25 basis point hikes from July. We now expect one of the two hikes in Q3 to be a 50 basis point hike. That's the call from the team at DB on the ECB, Lisa, for the path ahead.
And frankly, they got some confirmation from the ECB Governing Council member Robert Holtzman, who also supported a 50 basis point rate hike at the ECB. How much can they get ahead of inflation? But then if they get that right, what's the impact on the euro, right? Does it actually support the euro or does it actually make it weaker? We've been talking about this for a while, John, but honestly, unclear.
If you ask someone in the FX market that question, it's still so incredibly divisive. Tom, Deutsche Bank go on to say the following. We believe the ECB is continuing to underestimate inflation and we expect to support for a 50 basis point hike will increase as the summer progresses.
I would say 10 other houses can do that. John, what I find fascinating here, and I'm sure others will correct me out on Twitter and such. So what? They're going to make a first rate hike like the U.S., a first rate hike. Nothing really happens. Maybe even a second rate hike. Nothing really happens. And then maybe you get to some interesting things in the case of the U.S. in September. What are we waiting for?
Well, you know the so what of it. Rates have been negative since the summer of 2014, Tom. It's been 8 years.
Normalize. That's all I can say.
When do you speak to President Lagarde next?
I don't know.
Could you take this tone with President Lagarde the next time you talk?
She and I are watching the Platinum Jubilee together.
50.
Yeah,
Kick
right.
it up 2%.
Just lay the boot into BTPs. Get it done. TK. Futures unchanged on the S&P. I actually think you'll get a lot of support with that tone on Twitter.
Thank you.
To be honest with you.
Let's go.
The Nasdaq down 0.2%.
It's like the Red Sox. Let's go.
I can't wait for your coverage of the ECB next week. That'll be special.
You're waiting for my coverage of the Platinum Jubilee. I'm fully briefed.
Oh, yeah. Our Raw correspondent picking up the coverage tomorrow from New York. This is Bloomberg.
Keeping you up to date with news from around the world with The First Word, I'm Ritika Gupta. Treasury Secretary Janet Yellen says she got it wrong last year on inflation. Yellen made the admission in an interview with CNN. Last year, Yellen predicted that elevated inflation wouldn't pose a continuing problem. Now she says she didn't fully understand the circumstances. The U.S. is ramping up military support to Ukraine. President Biden says he'll give the Ukrainians advanced rocket systems and other weapons that will allow them more precision in attacking Russian targets. The weapons will let Ukraine hit targets as far as 50 miles away. The U.S. says Ukraine has agreed to not use the weapons to attack targets inside Russia. Investors are weighing the future of OPEC Plus unity just as ministers from the group prepare for a routine meeting Thursday. According to the Wall Street Journal, OPEC members are exploring the idea of suspending Russia from its oil production deal. That could mean an end to the OPEC Plus supply pact and see Saudi Arabia add more barrels earlier than expected. And the city of Shanghai reported its fewest coronavirus cases in 3 months. That came on a day when residents celebrated an end to mandatory home isolation for most of the city. Shanghai saw just 15 new infections Tuesday. That's a dramatic drop from the peak of more than 27,000 a day in April. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month and all year long.
I think I was wrong then. about the path that inflation would take. As I mentioned, there have been unanticipated and large shocks to the economy that have boosted energy and food prices.
Credit to Janet Yellen, one person in the administration with a mea culpa on inflation, the Treasury Secretary to CNN. From New York City this morning, good morning. Futures look like this on the S&P 500, just about positive 0.05% on the NASDAQ, negative 0.17%. TK, someone stepping up, stepping forward and saying, I got it wrong.
There's not enough of this. And of course, the reason is she is a first-class academic, grizzled academic in economics. And rule number one in academics is when you get it wrong, study why. And I'm sure she and others around her are really thinking of how they got transitory wrong. John, full disclosure, I'm going to cut him some major slack. There was a small matter of a pandemic.
Okay, Tom, but some people did get it right and they were ignored by this administration, by this Federal Reserve. There was a lot of groupthink going on within the Fed and within the White House, too, on this particular topic.
I think there were people, including Mr. Dudley, who's going to join us later, that did a lot better at this guesstimate than anything there. We'll touch on this here in a moment. Right now, though, we need to go to Anne-Marie Horton, our chief K-pop correspondent in Washington. Anne-Marie, let's go to the tape. Elbowing NBC, CNN, and Fox out of the way. Horton in the front row yesterday at the press conference for BTS. And it got a lot of play here, folks. The lads lined up in black suits and did what they did. But the answer, Anne-Marie, when everything's said and done, is they're up there for a serious reason, which is Asian hate crime in America. It was not light, was it?
No, this was certainly a serious moment having BTS at the White House. And obviously, given their supergroup, right, they have a ton of popularity. So this is a way the administration was able to amplify that message. And as I was walking out, there were fans outside. And I had tweeted a video of the fans asking me what they look like, what they wear, were they cute. I got a lot of Twitter inbox messages from other fans asking me to delete that because there's a fight within the supergroup fans. They're called their army. And there's a fight about the fact that some of these fans say they should have never showed up because they didn't want to distract from the serious message. So interesting moment. We should note that there was a ton of people in the briefing room. The second BTS left, Brian Deese came out. And he said, I got to tell my kids that BTS opened for me. And then a lot of other reporters also left. But obviously, Bloomberg, we stayed for the Deese briefing.
I know. V and Anne-Marie crush. Let's move on right now, Anne-Marie, to the meeting yesterday on inflation. And, of course, what Secretary Yellen said. All that's great. What does day two of the great Biden inflation battle look like?
Well, they're going to be dealing with this for the entire month of June as they make this concerted effort to really try to talk about the economy. One issue, of course, is that inflation was at 7.5% in January. So they could have been talking about this since the end of January, and they're really just making this effort now in June. Yesterday, when Brian Deese came out to brief us on this rare meeting the president held with the Fed chair and also with Secretary Yellen, really the takeaway was that he wanted to make sure, and the president wanted to make sure, that it is the Fed's job. It is the Fed's. This is in the Fed's realm. This is one of their mandates to control consumer prices. But the administration is also really trying to hammer home the fact that they are doing everything they can to bring down inflation. But then when you ask them, well, what about the tariffs? There's a lot of economists who say that could potentially, even if it's a little bit, that could potentially shave off some inflation. There's still no decision. So there's a lot of things still just in limbo that we don't have answers to.
And nothing is sticking, right? There was an NBC poll that came out earlier in May, and basically it found that 33% of Americans approve of the handling of the economy by the Biden administration. 23% approve of the handling of the cost of living. These are terrible numbers heading into the midterm. Will there be a shakeup in the White House at a cabinet level? And if so, who is going to get the boot?
Yeah, it's a great question. These poll numbers are scary, right? If you're looking down a few months of a midterm election, and this is really top of mind of American consumers. You know, Lisa, I can't answer that right now. Obviously, they're struggling and they're trying a few new communication efforts, I would say. You know, something we haven't really seen the president do is writing back-to-back opinion pieces, first in the Wall Street Journal, then in the New York Times. Potentially, this will help shake things up or different kind of messaging. But I don't know yet who potentially would would go. We did see yesterday that mea culpa from the Treasury Secretary, Janet Yellen, really the only one, though, to come out and own that there were mistakes to be made in this once-in-a-lifetime pandemic. Brian Deese was asked the same exact question yesterday, and he said things were uncertain and then kind of pivoted and then also said we're not the only ones to deal with it. Look at the Eurozone. They're north of 8%. So you don't know exactly where yet, but it looks like potentially if there was to be a shakeup, maybe in the structure of the management of the White House or the economics of it.
Anne-Marie, there was an op-ed in the Washington Post by Henry Olsen, and he came out and he said the Biden administration just laid out what they plan to do about inflation. And basically, it's clear he hasn't got a clue what to do about it. And basically, that's been, frankly, the takeaway for a lot of people. Is there any proposal that he has put out there that is garnering another opinion from experts in the field?
Well, there's a lot of proposals that have been put out there from the Biden administration that some say could work, but then, you know, like everything, there's debates on either side of the aisle on what could and what could not stick. I mentioned the tariffs. Potentially that can shave off some inflation, but many say that that would not be a good negotiating tactic when dealing and trying to combat a stronger China. Then there's the issue like the gas tax holiday. We've heard this time and time again. It's been floated, but others say that would it even get to the consumer? Would the end result hit the consumer, or would the industry just eat that up? So there's always these debates about issues, and you never really get to the final finish line of whether or not they're going to go through with it or not. If they're going to fight inflation, then is that going to be the key focus, or are they going to use the, you know, issues that potentially on each thing, gas tax, tariffs, there's always going to be something else that there's going to be a pushback, and there seems to be a lot of debate on which lever they should pull.
MH, thank you. Anne-Marie down in DC on a lot of things, including K-pop. TK, just quickly, the NBC report that came out in the last couple of days on the increasingly frustrated president, the name that came up within that was Ron Klain. Greg Valliere came on the show how many weeks ago, Tom, and talked about that. There was a target on his back. I think it's a matter of time for a lot of people now before he goes.
There's a tradition to this. Ron Klain is hugely respected on both sides of the aisle, John. I don't know the details. I don't know what's inside the White House, but always the chief of staff is the focal point. And what's important here is President Biden has 4, 5, 6, 7 candidates to choose from of different character, and really it depends on which way the president wants to go.
Clearly a massive effort in the last couple of days, Lisa, to shake things up and sharpen a message.
Yeah, but is any of it sticking whatsoever? Is there a new message? I mean, honestly, do you hear a message coming out, or do you just hear a lot of new kinds of speaking points thrown at it?
You mentioned the polls. And let me tell you, every time we get a CPI print, it sticks all right. It sticks to this White House, and they can't shake it. Futures unchanged on the S&P from New York City this morning. Good morning. This is Bloomberg. Sometimes, in fact, quite often, things don't feel the way they actually are. For the month of May on the S&P 500, don't worry, this won't be a therapy session. 0.01% higher on the S&P 500 last month. It didn't feel that way, but that's how it was. Futures this morning, exactly 0.01% higher as well, matching the gain we saw throughout the whole of May. Futures on the Nasdaq down about 0.2%. A note from Citi coming into this morning saying that yields haven't topped and equities have not bottomed. Let's take a look at the bond market. Yields lower through the month of May, particularly at the front end of the curve. Your 2-year 256.87, just a little bit higher on the session by a basis point, on a 10-year to 285.67, up about a basis point on a session also. The story for a lot of people going from the Fed to the ECB next week, June 9th, President Lagarde, and euro-dollar very much in focus. Deutsche Bank out ahead of that, saying in Q3 expect 2 hikes, and one of them could be 50 basis points from this ECB. TK euro-dollar 107.19.
We massaged that in the last 30 minutes. John, what about the ISM numbers today? You're bigger on them than I am.
A little bit of soft data, Tom, some survey data. I think the JOLTS data is going to be the one that gets a lot of people's attention.
Okay.
It's dated.
10 o'clock?
It's dated, so I'll say that up front. But for a lot of people, that's the target for this Federal Reserve. Yeah. Can you bring down job openings? Can you rebalance the labour market without pushing unemployment up too high? Tom, that is such a delicate balance. And the Fed's going to be trying to do this with some data that's a little bit old, a little bit stale.
Well, and again, a little bit stale is Brent crude 117.20. We need to remember that that is elevated as well. Right now, let's elevate to the equity markets and looking at it through the math and derivative strategy at BNP Paribas of Greg Bowdle, head of their U.S. equity shop. Greg, what do the derivatives say right now? What do the cross moments say about the bet on equities?
Good morning. Thank you, Tom. When we look to the derivative market, we actually see some remarkable similarities towards what we saw in the back end of 2000, 2001, 2002, that bear market. When we look at the range that the VIX has been trading in, it looks remarkably similar to that regime.
Okay, well, it looks like that regime, we had a May that John mentions was flat, flat, flat. Is it giving you a direction? Is there a bet within the equity market, and particularly within derivatives, that signals some form of June, some form of bet for June?
Well, I think what we've seen over the last week is very much a bear market rally or a dead cat bounce. What we've seen in terms of the price action, the laggards in the last month or so in this sell-off have all outperformed. It's really been a mean reversion trade. We've moved into month end, and we think there was some decent buying pressure that supported the market. And we now find ourselves in a little bit more no man's land. What we think is going to drive the market forward over the next coming week and over the next coming month, whether that bear market rally will turn into something more sustainable, is exactly what you were talking about just before I came on the show, and that's the macroeconomic data.
So, Greg, it sounds like you agree with both Citi and Morgan Stanley in saying that basically the valuations have to continue to re-rate downward, that we are not done with this repricing. Is that correct?
No, I don't necessarily think so. I think we're in a regime that I would describe as very much a bear market regime. But I think it's been driven by two things. One is an extreme multiple compression that we've seen this year. The type of multiple compression we've seen on the S&P PE, we've only ever seen in a recessionary environment. So our view is that we're in this kind of bear market environment, yet we haven't seen the recession manifest in the macro data yet. So we still think there's a path for the US economy to have a soft rather than a hard landing. And in that type of environment, P multiples, although they're not cheap in absolute terms, we don't think are expensive enough anymore that it's necessarily going to prohibit the market rallying from here. So we think if the macro data comes in a little bit less bad than people are anticipating through the second half of the year, that could actually set us up for an equity market rally.
So do you think that it's good to position for that, given the uncertainty, given the wide band of potential economic outcomes and, frankly, earnings as well?
I think it's incredibly difficult to have super high conviction on where the market is going to be on a 1 week or a 2 week view. But over a medium term view, we think the retracement that we've seen year to date is more than justified by the economic data. So if we do have the data improve, we think it sets ourselves up for certainly some of the more cyclical parts of the economy and the market to perform. So we think the current spot levels for the equity market could remain choppy, but ultimately we think we end the year higher than where we are now.
I mean, Greg, I love the idea of a dead cat bounce, and of course that's written up at BNP Paribas as rebound du chat mort, or something like that as well. It's a phrase we hear a lot, and it's a cheap phrase, but you're a grizzled pro. Describe for us the symbolism of a rebound du chat mort.
Oh, please.
Thank you, Tom. I think the thing which most obviously characterizes this is a lack of new leadership and more just a mean reversion trade. So when you look over the last week, when the market has had this bounce, you look at what has led the market, what has lagged the market, it's the exact mirror in terms of price action of what we saw in the prior month. So I would look for two things to confirm that this is less of a dead cat bounce and more of a sustainable rally. One would be new leadership. So actual constructive moves from stocks driven by better data. And the second thing we'd look at is a further normalization of the volatility market. We'd look for that VIX spot level to come back towards the low end of the range.
Okay, this is really important. Give me a VIX level that you've got your eye on here. We're at 26.33 right now. I watch this like a hawk like you do. Give me that level that signifies the end of les rebonds du chat mort.
I think if we move lower from here, so we view the lower end of the likely range that we could trade in the VIX to be around 20. We don't see us moving back into a high teens.
Mon Dieu.
2-0. We don't see us moving back into a high teens regime or a mid-teens regime very soon. But we do think we can get to the bottom end of that range around 20, and we do think that would be be a good signal that we could be in for a period of more comparative calm.
Greg, I give you incredible credit for maintaining a straight face, as Tom Keene butchers French. I do wonder going forward what you see as the dichotomy between retail positioning and institutional positioning, something that you've picked up on, and say that it indicates perhaps more of an unwind in specific names. Tell us about it.
Yeah, I think that's a great question, Lisa, and it really comes to the core of our thesis of what we think could out or underperform through the balance of the year. Yeah, when we look at equity markets and what drive them, as I said, macro data is important, valuations are important, but ultimately it's positioning and flows that really moves the market. When we go around and speak to a lot of institutional accounts, we get corroboration of what we can already see in the data, that hedge funds have degrossed, asset managers have put cash on the sidelines. Now that is at odds with the picture that we see in retail positioning. In retail positioning, we still think that there's a lot of excess in the market. Now, the interesting thing about that is those two pockets of investors have tended to be concentrated in different areas of the market. So retail have been much more concentrated in some of these more euphoric, ultra-high growth stocks that have already been underperforming, but still look expensive relative to value stocks, and we think that rotation could have much further to run.
So, Greg, I was actually immediately looking at GameStop, and it's down more than 15% and down ahead of the market. Does this matter to the broad overall averages, or is this just noise on the peripheries?
No, I think any single stock, particularly a small or mid-cap stock, is noise around the edge. Now, we can take a signal from what those stocks are doing more collectively. We put a basket together back in November called the Cappuccino Basket. This was BNP's play on the frothiest names in the market. We've seen that basket half over 5 months. So taking a collection of these smaller idiosyncratic stocks that are not necessarily any one of them going to move the needle, we think is a much better way of looking at it than focusing in on one single name.
Did you say the Cappuccino Index?
The Cappuccino Index, the frothiest names in the market, Tom.
What are you going to do with a basic call here for the equity markets? Away from a Cappuccino Index, is it just about profit and free cash flow forward?
Yeah, I think the best single metric that we can find for timing equity markets is earnings forecast revisions. So whenever analysts are putting through upgrades or downgrades to their forecasts. What we've seen this year is those downgrades have been very concentrated in the growth names. So when you look at the earnings momentum for the NASDAQ, it looks pretty poor. When you look at the S&P, it looks more reasonable. When you look at something more cyclical like the Russell 2000, it actually looks pretty okay. So that's one of the gauges we're looking for. When we move into the next earnings season, that's going to move the needle again. But to the extent that we see better earnings momentum in some of the cyclical names, this is one of the things that's giving me a little bit more comfort that maybe we're heading potentially towards a soft rather than a hard landing.
I'll tell you one thing, Tom, no tickets for us for Roland Garros after that.
Got that right.
Greg Bowder, thank you, of BNP Paribas. Johnny Filion is not going to let him on this show again, Tom.
I thought
you've been practicing your French.
I don't know about the practice of my French, but our love of cats is so sensitive.
Of course. Last time we did this, Tom, the cat mafia called in. I'm not going there.
The cat mafia.
Got nothing to say about cats.
Let's talk about the French Open. Exciting, huh?
Rafa Nadal. Tom, I get so emotional watching Nadal that I can't even watch him play tennis.
Admit, I play dumb, but
deeply invested in that guy. Just phenomenal. And the smile on his face yesterday at the end of that game against Novak, just joyous, Tom.
He's not a young guy in that heat.
No, he's not.
It's something.
And he was upset that they had to play so late as well. I saw a headline, Tom, that the game started in May and ended in June. Went through midnight in Paris. Just unbelievable, and good luck to him in the semi-final.
Well, we'll see there. He's got semi-final, so he's got to play the semi-final, then the final, right?
And that'll be number 14 at the French, Tom.
Very good. Okay. Well, we'll have to see on that as well. I see a mixed market. We're sitting here on the data, John, and I'm going to go back to the data this morning, John, and I think that just within all the turmoil, it's not another June 1st. This is some data that matters, as you mentioned, the jolts later.
ISM data, to what degree will we see some form of deceleration here, Lisa, in the ISM a little bit later, and then on to jolts after that, then on to claims and payrolls through the rest of this week?
It's so noisy. I mean, all of the economic data points have had less and less significance as it really just all adds up to a sea of mush. But I do think I get your point.
A sea of mush.
A sea of mush. I was, having breakfast in London. Honestly, I do think that jolts is going to be...
Did you just call breakfast in London a sea of mush? Is that what that was?
No, there was a lot of.
Lisa.
I actually really enjoyed it. It was I had avocado toast.
Right before the Queen's Jubilee, you're calling English breakfast a sea of mush.
Oh, come on. Queen's got,
Come on.
for the lunch there, she's got to have a full
It was with
English.
love. I like mush.
Do I get tomorrow off and Friday?
You get an
How's this
extended bank holiday.
Do I really?
Yeah.
So I don't have to come in tomorrow or for payrolls. Awesome. Futures unchanged on the S&P. From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. Ukraine will get advanced rocket systems and other weapons from the US President Biden made the announcement in an article published in the New York Times. The rockets will allow Ukraine to hit targets up to 15 miles away. The US says Ukraine has promised not to attack targets inside Russia. In the UK, consumers are being urged to brace for inflation getting worse before it gets better. The British Retail Consortium says that fresh food prices are now rising at their fastest pace in a decade. It says fresh food rose 4.5% in the year that ended in May. China is planning for years of COVID zero, with testing sites on almost every corner. Tens of thousands of lab testing booths are being set up across the country's largest and most economically vital cities. The goal is for residents to always be just a 15-minute walk away from a swabbing point. The richest person in the world doesn't appear to be thinking much of working from home. Elon Musk apparently sent an email to the executive staff at Tesla with the subject line, "Remote work is no longer acceptable." He wrote that anyone who wishes to do remote work must be in the office for a minimum of 40 hours per week or leave Tesla. And the new Top Gun movie had the biggest ever theatrical debut for a Memorial Day weekend. Paramount's Top Gun Maverick brought in more than $160 million worth of ticket sales in North America through Monday. That lifted the spirits of movie theater operators hoping to bounce back from the pandemic. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
My plan is to address inflation. It starts with a simple proposition. Respect the Fed. Respect the Fed's independence. They have a laser focus on addressing inflation, just like I am.
The President of the United States saying respect the Fed, sitting alongside Chairman Powell. Tom, what did you make of this? It was a little more elegant than the former administration, but ultimately making the same point, isn't he?
Yeah.
In just a more subtle way.
Exactly.
Respect the Fed. I respect the Fed, but
well
it's
said.
Their job, not ours, to sort this out.
I thought, for pros on the street, it was a colossal non-event. I thought it was timid. I thought it was tentative. And the differences, and John, you were talking about this on the break when we weren't talking about Nadal, and that is that there's a difference of relief from inflation versus moving the needle of inflation lower, as we'll speak to Adam Posen here later.
Well, Tom, that's a point you've been making too. So just elaborate on that a little bit more, what we can do about inflation to bring it down and how we can provide some relief to consumers who are getting really squeezed right now.
I mean, take the giant of Brown University, William Poole, and all of his public service. It's real simple. You've got a monetary solution and you got a fiscal solution. In an election year, the fiscal solution is just flat out. You're not going to do a fiscal contraction to slam a nation into recession. So you're on the monetary side, a la Dudley, and what we're arguing about is simply the speed to get there, to get to some form of there, understanding that there's a complete mystery on rate rise.
Over to you, Chair Powell, Tom.
Yeah, well,
bottom line.
We'll have to see. And I don't know. I'll leave it to Emery Horton to tell me about it. I mean, she was more focused on K-pop than she was on that
So
meeting.
were you, to be fair, Tom.
Expert on K-pop, teaching a course there Wednesday nights is Wendy Schiller at Brown University, director of the Taubman Center for American Politics. Wendy, I want to talk about one-term presidents. And, of course, I'm being bold here and suggesting maybe Mr. Biden, like Mr. Trump, is a one-term president. What do the last 2 years of a one-term president look like?
Well, obviously, Tom, you're pointing out sort of speculation right now. Two fronts. One is, what kind of Congress do you work with? Do you work with a narrowly controlled Democratic Congress or a narrowly controlled Republican Congress? And we don't know that yet. So we're going to have to wait and see. Presidents tend to look towards executive orders. They tend to try to do things to get around Congress when they have that circumstance and do as much as they can through the executive chain rather than the legislative congressional chain. There's also going to start to be a bit of a free-for-all in the Democratic Party if it becomes clear that either Biden doesn't want to run or can't run or, will step aside. Right. Then you've got those dynamics, which will get very, very messy pretty quickly when those signals appear.
Wendy, years ago, you sat with me at the bar at the Black Pearl in Newport, Rhode Island, and you said, Tom, you got to read your Alan Nevins. So I read my Alan Nevins about the 1890s. To me, it's a lot like the 1890s pre-Teddy Roosevelt with huge polarized America. Is that close?
You're spot on, absolutely right. If you look at the levels of polarization, and people do these figures all the time, the gap of polarization and division was as high as it was then as it is now. The difference is the range of issues is so much broader, right? The government does so many more things that we are divided along many more dimensions than we were then, but they were still very divided. And the parties were in flux, particularly the Republican Party was really a mess in the 1890s and the 1900s. So we're going to have to see if the Republicans can get out of their own way moving forward. So Biden may have not as difficult a time, theoretically, if the Republicans are divided amongst themselves. And that's going to depend on the big T, meaning Donald Trump. How much does he intervene? How much does he pressure members of Congress once they win the majority? If they win the majority, you've got terrible economic conditions, I think, for the Democrats, you rightly point out. But there are other issues on the horizon. Gun violence, sadly, is very much present again. And of course, we have abortion. So these can mobilize constituents that didn't vote for or who the Republicans were already counting on. And it raises levels of uncertainty going into November.
Wendy, if you were advising President Biden on how to rearrange his staff and how to position best heading into the midterm elections and, frankly, out of them, what would you recommend?
Well, he's got a Commerce Secretary. I'm a little biased. She was the governor of Rhode Island, and I'm from Rhode Island. But she's good. She's good in crises. She's good on TV. And she got national attention handling COVID in our state. So if you can get that kind of attention from a little state like Rhode Island, think about what you could do on the national stage about the economy. So he's got to put more of his cabinet members out front, which, Obama didn't do either. And so you have to think to yourself, you've got some stars, people that can help you, get them on the road and get them out there.
Professor Schiller, we saw Secretary Raimondo in Davos. She was wearing a Browns men's hockey T-shirt. She was like exercising, getting in a couple miles.
Well, she didn't go to Brown, but she got along well with Brown.
She financed it.
Thank you, Tom. Wendy,
I didn't go to Brown either, so.
Yeah, but she financed it.
But Wendy, your view here is actually exactly counter to a lot of what people are saying, which is to actually get rid of cabinet members. You're saying push them forward more, make them more visible, make it less Biden focused. Talk a little bit about how unpopular your view is and why that might work.
Well, I have been advocating staff change on the communication side for Biden. And Psaki did a good job for a while, but it was time for a change. We'll have to see how that change works. But the general infrastructure, the staff that's advising him, he's got a lot of long-time people. He's very loyal. He's been around a long time. But you need people with a fresh perspective, people who are on the ground, newer people, younger people, perhaps, not to be ageist. But you need to, I think the internal staff, I think the circle of advisors has to change. And the communication staff, I think, has to ramp up better. But presidents don't like to do this. They finally got there. They want to run the show, understandably. But then you're Jimmy Carter. And that didn't turn out too well. Is
Joe Biden Jimmy Carter?
Well, in the sense that he knows a lot, right? We know that he's been there a long time. He's been in the hot seat. So and he's with it. People claim he doesn't know what he's doing. I don't think that's true at all. So, he's got to let go a little bit and let the people who are the next generation, who are good, who've proven to be good in communications in his cabinet, out the door and send the message out that the Democrats are better in economic crises than Republicans, which history shows to be true. We're not hearing that message at all.
Wendy Schiller, thank you.
It's great.
Wendy, great to catch up, as always. Headline just caught my eye. Just want to bring it up just quickly. A financial services company, S&P Global, suspending guidance for 2022 on macroeconomic conditions. Lisa, if that doesn't tell you a lot, I don't know what does.
I mean, this is a company that literally tracks other companies and their earnings.
Literally, that's what they do.
Literally, that is what they do. And they have no clue. So that tells you everything you need to know about how difficult it is to get any visibility right now whatsoever.
Unbelievable, Tom, just to read that headline.
I've never seen that. That's extraordinary, John. You're absolutely right.
Isn't it bizarre?
It's the times are bizarre. That's perfectly said, but it's not S&P Global. It's bizarre. It's the times we're living in. The math of this, John, way out on the right side of the equation is an epsilon, a Greek fancy letter that means we don't have a clue what we're doing, and that epsilon now is original.
Isn't it your job, though, if you're S&P Global, to have a clue what you're doing on stuff like this, Lisa? How many examples of this have we seen now?
Yeah, and they talked about significant deterioration in macroeconomic backdrops. I wonder how much, read supply chain disruptions, the issues in China, the prices of some of the materials, but also debt issuance, right? Because they rate debt issuance. And the unclear aspect of how much debt companies are going to want to raise, given how much higher interest rates are, is a big wild card for not only the S&P, but also for big banks.
A little bit awkward the next time you put out a rating, isn't it? On a country and your own company.
We have no idea.
Can't provide any guidance on the future. This is Bloomberg.
I think the Fed is very aware that the U.S. economy is already showing signs of easing, that we're already seeing cracks in the armor.
Companies are still able to pass costs through. But again, as we reach higher and higher price levels, that becomes more difficult.
There's this frustration with where policy is headed.
Tightening will get us down to about a 4%, but getting down to a 3% probably is going to engineer a recession.
The reality is, I don't think they're going to be able to raise as much as markets have priced in.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Futures just about positive, 0.01%. TK, new month, same problems.
New month, same problems. Deceptive market today. Really, John, just to churn to the market. We don't even need to go into it. We'll do a mini data check here to get to the major call, John, which is what happens not in this June. What happens in July? What happens in August? Complete, total mystery.
And Tom, how do we reset in September? September 21, that's the date in your diary, the date in so many people's diaries. What happens when this Fed gets around a table? They hiked 50 in June, they did it again in July. What's in store in September?
What's in store is the data is going to be there. And by that time, John, corporations are going to really begin to adjust to the cards dealt to them. And I'm not predicting a massive cost cutting by corporations, but it's got to be in their mind, and particularly to speed up their rationalizations of 2023.
Because right now, Bramo, these corporations are struggling to get any visibility on the future.
Yeah, you pointed out this headline, and I'm actually just sitting here thinking about it. The S&P Global, this company, suspending 2022 guidance on macroeconomic conditions. Basically, they have no clue. Their job is to rate companies. Their job is to actually have visibility into a corporate activity and what is going to happen ahead. They have none. What does that tell us about how much visibility there is? And then how does the Fed arrange on this, which is the reason why so many people think that ultimately it's whatever way they decide to shift that's going to determine the path of the markets, because everybody else just sees a whole slew of mush.
So many people are getting caught wrong-footed. We've seen it corporation across corporation, industry across industry, of corporations and leaders, policymakers struggling to gauge where demand is going, Lisa, and struggling to recalibrate their company to have the appropriate level of capacity to meet that demand. And we've seen that repeatedly over the last 12 months and over the last few weeks, mistake after mistake after mistake coming to the surface.
Capacity with respect to goods and capacity with respect to employees. And I think this is important. It's the reason why we're watching that JOLTS data that comes out later this morning. How many job openings are there? When do companies start to pull back on their employment because they don't want to be caught wrong-footed, overly employed, paying people higher wages at a time when there is such fluctuation in terms of the macroeconomic conditions?
Well, Elon Musk has a plan, Tom, over at Tesla. Remote work is no longer acceptable, Musk says. Anyone who wishes to do remote work must be in the office for a minimum, and I mean minimum, of 40 hours per week or depart Tesla.
This is a tinderbox, John, and I don't know which way it cuts. I don't have any wisdom on this at all, other than senior officers running out of patience seems to be the
you think
the rate of change here.
Do you remember this time last year, Tom? Do you remember, get back to the office by Labor Day? Labor Day. Enjoy the summer, because in September it's back to work. What happened?
It didn't happen. I mean, in the Midtown Manhattan folks where we're located, it decidedly did not happen. I don't know what your story is. Tell us about your story. John, do a data check here and save me right now.
Before people tell us about their stories, and phone in. We should do a segment on that. Phone in from your trading floor and tell us about your story.
And speak French.
And do it in French.
Damien Sassauer can phone in from Turks and Caicos. It works.
Futures positive about 0.05%. Really flat month through the month of May. Kicking off June with more of the same. Yield higher by a couple of basis points. Bramo on a 10-year, 286.22.
This is what we're watching today. Quantitative tightening supposedly starts today, formally anyway. It doesn't actually start until June 15th, when about $15 billion of treasuries rolls off, comes due. How much can they get the balance sheet down, the $9 trillion balance sheet, at a time when a lot of people are expecting this to have a bigger influence over markets than many people have priced in? 10 a.m., I'm watching this because the Bank of Canada, frankly, has been a sort of precursor to the mood in other central banks around the world. They're poised for their second 50 basis point rate hike at today's meeting. This comes on the heels of record CPI, like we've seen all over the world, but also in Canada. Do they get more aggressive? Do they stay more aggressive? Do they indicate they will remain so going forward? And what does that mean for the Fed, for the ECB, especially as the hawks start to get louder? And today, talking about hawks getting louder, we hear a slew of Fed speak, including New York Fed President John Williams at 11:30 a.m., St. Louis Fed President Jim Bullard at 1 p.m., also the former New York Fed President Bill Dudley joining us here on Bloomberg Television in about 45 minutes' time. John, you talked about that JOLTS data, the job openings data. How much does it start to come down? We have nearly 2 job openings per unemployed American. How does this actually trickle out into a labor market that, by all accounts, is overheated, by all accounts, isn't really getting that much better? And that is a big concern, clearly, for the Federal Reserve.
It's this perfect picture this Fed's trying to paint and ultimately trying to realize. And Lisa, it's really difficult. You've got to bring down job openings, take out some demand, some heat from this economy, rebalance the labor market without seeing unemployment go much higher. That's a tough, tough job to try and execute.
Which we will hear from Bill Dudley about how to be realistic and what realistic guidance from the Fed might look like. I'm sure he'll have a lot of things to say on that.
Looking forward to that. Joining us now is Stuart Kaiser, the head of equity derivatives research over at UBS. Lucky to have Stuart with us in a studio. Stu, let's start here. Big squeeze last week. You called it a low conviction rally. Talk to me about how you saw investors using that rally to reposition, readjust and protect themselves once again to the downside.
Yeah, great. Good morning, Jonathan. Yeah, and that is how we termed it, I think, mainly for 2 reasons. One is that, during the rally, we just saw investors adding to hedges. So put open interest rose pretty considerably across most U.S. benchmarks, across U.S. home builders, and in the retail sector. So it did seem like people were using a higher price point to kind of reset hedges as the market moved higher. And then secondly, frankly, it was just a very low volume rally. So there wasn't a whole lot of participation either in the option side or in cash market. So it certainly seems like either folks are out of the office or they were just using this as an opportunity to kind of reset their protection.
Stuart, what does that mean for the NASDAQ move that you've been waiting for quite a while now over the last few months?
Yeah, I think what it means is you've really hurt sentiment, over the course of the last 3 months, and it's going to, take a preponderance of data to get people more engaged in the market. We think that's underway. You've had 2 CPI and now 2 PCE prints that we think look relatively positive for our inflation outlook, which, calls for a pretty significant decline in inflation, over the summer. Inflation break-evens are lower. Rates have come in a bit. So I think all of this is incrementally positive, but really it's a critical mass issue. And I think for investors, we haven't, reached that critical mass. And folks are still focused on recession risks if the Fed needs to aggressively tighten. And until we see, again, a critical mass of inflation data, I think the market's going to be pretty cautious about executing that view.
I heard a little sigh as you spoke, and I'm wondering how difficult it is right now to be a bull.
It's not easy, but I mean, if S&P can, get rid of their guidance, I guess I can get rid of mine too. So, that'll make it much easier for all of us. Look, it is very difficult. I think, we view this as kind of a 3-step process, and we're in step 2, which is, essentially accumulating enough data and evidence that you can be confident that this decline in inflation is underway. It's going to take some time, and with sentiment as negative as it is, you're also overcoming kind of the animal spirits, aspect of this as well. So it's been difficult, but we're trying to stay close to home, which is focus on the fundamental data. And we do think that data is moving in our direction, albeit relatively slowly.
Well, how do you even look at the fundamental data? You mentioned S&P Global, so let's go there, right? Suspending 22 guidance. What's notable, as Marty in the newsroom points out, is that they just gave guidance on May 3rd. So that indicates that in just a span of about a month, things changed so rapidly that they withdrew it. What does that mean in terms of what you should be clinging onto and how to interpret data that's already dated by the time it comes out?
I think it's a great point. I think the same thing happened to Snap, if I remember correctly. They posted guidance and then quickly kind of, shortly thereafter cut it as well. It's really difficult. I think, honestly, the confidence intervals around these forecasts are incredibly high. I think that applies to us and for the Fed as well. I think you need to track the high-frequency data as much as you can. And really, I think, to us, it's identify the signposts you're tracking and really kind of focus on the data in that way. And, from us, from an inflation perspective, that really gets back to wages. So it's looking at, composition-adjusted average hourly earnings. It's looking at, kind of core services and really keeping a close eye on what that is, because we think that is kind of one of the key signposts to matter. So I think, look, the data is going to be volatile. I think you need to identify a few signposts that you're comfortable with, that you think are going to ultimately determine the outcome, and follow those, frankly, as closely as you can, and not listen to the radio too much, I guess. I don't know.
Well, be careful what you say there, Stuart. Did he say that? It's not my fault, Al. I'm sorry. Okay, Stuart, I want to talk about the easy move on pandemic inflation from 8% down to whatever percent. How do equities respond when we get to 5% inflation?
Look, I think the process of getting from 8 to 5 is going to be very, very positive for equity markets. I think the question, and
then what?
That's the big question. That's the debate we're having with investors. It's not necessarily whether it's peaked; it's the rate of decline and what level it kind of settles at. And we think it's going to get back into the 2 to 3% range on core inflation by the end of this year, and that's on a year-on-year basis. But to your point, if we get into the 4 to 5 range and it looks to be stalling out there, I think that's actually quite a negative outcome for equity markets, because then the Fed is going to have to probably slow demand materially. So the debate really is rate of decline and what level we settle at. And in either case, though, I think there is a tradable window there. If you go from 8 to 5, I think risk assets will respond positively. If you think we're going to settle at 5, then that window is shorter, and you need to approach it maybe using options in a more risk-adjusted fashion. If you think we can get down to 3 or 4, then I think you can run more risk.
And John, I don't know. It was Stuart Kaiser on radio and television.
Turn it down, apparently. Tom, is Stuart allowed back? So. I think he is.
Yes.
Stuart Kaiser, UBS. Stu, great to catch up, buddy. As always. TK, I think Mohammed mentioned this with you guys last week, just the potential for a stop-start from this Federal Reserve, that even if they do have to pause in September, ultimately, to Stuart's point, if you settle down at 5, you've got to go again. And you've got to go again.
And what's important, what Mr. Kaiser said there, was the idea of core versus top-line inflation. The media is focused on 8%, 7%, all the ugly numbers. Core is 6-ish right now. That's still way too high. But what does core do if it gets to 4?
I'm just looking at the estimates for next week for headline. June 10th is when we get that read on CPI. 8.3% the previous read. Survey at the moment, there's only 4 estimates in so far. 8.2%, so far still with an 8 handle. And Morgan Stanley with a pretty punchy estimate from Morgan Stanley too. We'll get into that in just a moment. Futures are positive on the S&P by about 0.1%. The Nasdaq just about negative by not much at all, and yields are higher by 3 basis points, 287. From New York City this morning, good morning to you all. Kicking off a month of June with a flat market.
On radio.
This is Bloomberg.
On television.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. Treasury Secretary Janet Yellen says she got it wrong last year on inflation. Yellen made the admission in an interview with CNN. Last year, Yellen predicted that elevated inflation wouldn't pose a continuing problem. Now she says she didn't fully understand the circumstances. Meanwhile, the Federal Reserve is about to deploy a second tool to curb inflation alongside higher interest rates. It will begin shrinking its $8.9 trillion balance sheet. Officials don't know how effective that will be. They say it should cool price pressures by tightening financial conditions. And the U.S. is ramping up military support to Ukraine. President Biden says he'll give the Ukrainians advanced rocket systems and other weapons that will allow them more precision in attacking Russian targets. The weapons will let Ukraine hit targets as far as 50 miles away. The U.S. says Ukraine has agreed to not use the weapons to attack targets inside Russia. The city of Shanghai reported its fewest coronavirus cases in 3 months. That came on a day when residents celebrated an end to mandatory home isolation for most of the city. Shanghai saw just 15 new infections Tuesday. That's a dramatic drop from the peak of more than 27,000 a day in April. And Deutsche Bank has replaced the CEO of its DWS group hours after a police raid at the asset management. Ashoka Woermann will be succeeded by Deutsche Bank executive Stefan Hoops. The raid had to do with allegations that DWS made unsupported claims about ESG investments. Global news 24 hours a day on air and on Bloomberg Quick Take. I'm Ritika Gupta. This is Bloomberg.
We have unique economic strengths which position us well now to focus on this challenge, which is bringing prices down. Obviously, the Federal Reserve plays a primary role in that, but fiscal policy and the economic choices that we make with Congress play an important role as well.
Brian Deese there, the director of the National Economic Council, on the moment we're in right now. Futures on the S&P positive by 0.13% as we kick off the month of June, closing out May with a really flat market, positive 0.01% over the month. Yields are higher by about 3 basis points on a 10-year, 287.31. No drama here. Euro dollar 107.14, negative 0.2%. Some drama here for next week, Tom. June 9th, with the ECB decision just around the corner.
The ECB decision is there, and part of it's commodity-based. And, John, you know, Brent crude 117.30 after the fireworks yesterday is still, to me, elevated from where we were X number of weeks ago. And I noticed, John, Newcastle coal down in Australia, not out to new highs, but breaking higher again.
We were whipsawed yesterday, Tom, by that report in the Wall Street Journal that maybe
noise.
OPEC ditches the plus and goes without Russia and ultimately goes forward and does some kind of production deal without them.
Yeah,
What do you make of that? I mean, the market completely turned around on it.
Yeah, I just think it's noise, and, you know, there's an OPEC noise, and we all need to do, I think we need team surveillance in Vienna again for their next 20-minute
It's noise, but you want
to
finance a trip and cover it.
You know,
okay.
Team coverage. But when I look at it, John, to me, it's just we're sustaining here nicely above 100 a barrel.
But one number matters, Tom,
means.
and it's not that one. And Anne-Marie puts it out every single morning now. It's the average price of gas.
AAA unleaded there, breaking out the new highs yesterday. We'll see what the quote is this morning. Anne-Marie Horton joining us now, our Bloomberg Washington correspondent. Anne-Marie, I want to go to the actual policy now. And we see in China moments ago an $800 billion infrastructure, whatever. I don't know what it is. It's $120 billion U.S. supposedly. I don't know what it is. Where is the fiscal impulse of this White House? That's one thing they can do, is heat it up a little more into the election. Can they?
Well, Congress would have to help them act, right? And so far, this administration hasn't been able to get even every single member of their own party on board. I'm talking about some of the provisions that they want to do when it comes to the the Build Back Better proposals. Potentially before the midterm elections, you could see movement on maybe prescription drugs and also some climate provisions. But that big package we were talking about this time last year, that's not happening before November.
Are the senators from West Virginia and Arizona, are they diminished in power as we go into the summer, starting this June?
I actually would argue that potentially they have more power in these final months, that they are likely going to wield this power that they probably potentially may not after the midterm elections if Republicans are able to snag a few more seats. So right now, really, their positions have a tremendous amount of power because it's the 11th hour for this administration this summer to try to get anything done that they can only get done if they have every single Democrat on board.
Anne-Marie, what a busy couple of days for this administration. Let's go through it piece by piece. We had a report from NBC News yesterday that the president was becoming increasingly frustrated by those around him also, and wanted to sharpen the message. We've had an op-ed piece in a Wall Street Journal on inflation, in the New York Times on foreign policy, a mea culpa from his Treasury Secretary, and a meeting with the Fed chair where it felt like it was more of a it's them, it's not us kind of scenario over inflation. What do you make of what's transpired over the last few days?
Yeah, that was a bit of a pass-the-buck photo op, and then Brian Deese only came out to reiterate that message that this is the Fed's problem. We know that the White House aides have told us that they are making this concerted effort in June to refocus and talk about the economy, because this is the #1 issue that is really starting to hit them very badly in the polls. I believe it's the earlier poll this month from Washington Post. It was 9 out of 10 do not agree with how the administration is handling the economy. And the biggest issue, of course, is inflation's consumer prices. And talking about that NBC poll report, Jonathan, and also some stories in Politico, this is something the administration focuses on. Like every day, I check gasoline prices and I tweet about it. This is what Ron Klain does as well when he wakes up. And it doesn't matter what the administration puts out in the New York Times, in the Wall Street Journal. If you have a car or you're walking on the street in America and you pass a gas station, that is advertised every single day.
Anne-Marie,
the price of per gallon.
So let's end where we began with this report in the Wall Street Journal about the potential for OPEC Plus to exempt the Plus, Russia, basically, from some of the production targets. Basically, a nod to the United States, to European nations by Saudi Arabia, saying, you know what, maybe we will kick up production substantially to offset the fact that Russia is decreasing its presence on the world oil stage. How significant is this, and how much does this have to do with the trip of President Biden to the Middle East?
Two things. One, I would say that Saudi and Russia are still definitely working together. You have Sergei Lavrov in Riyadh today. So I think that speaks volumes about where the crown prince and the kingdom view their relationship as well and want to keep that relationship with the Kremlin. But if this is to be true and the plus part of OPEC Plus starts to diminish, I'm not sure if so much of this is the Saudis really trying to make sure that they're falling in line to what the United States and maybe other consumers wanted, even others saying that how can you do business and have this partnership with Russia given the war in Ukraine. If they don't have the oil and they cannot export it and they cannot reach their production limits, then what does the new deal become? Saudi and the UAE, the only two that really have the spare capacity, it's inevitable that they're going to have to step in.
AMH, thank you. Down in D.C., outside of the White House. Anne-Marie will catch up a little bit later. Big turnaround in the oil market yesterday. If you're just tuning in, crude pushed 120, 119.98 at the highs. Then off the back of that Dow Jones story, Tom, big turnaround, 116.22 right now on my screen.
Yeah, it's very, very volatile. And, you follow it technically and the rest of it as well. But, John, I would also look at the blended indices. I think it was you, John, that mentioned copper yesterday as well. I got to be honest, I'm watching copper more than anything.
Well, Tom, I give you credit to bring up China time and time again over the last few weeks and pushing that through the commodity market.
I'm sorry, this is a huge deal as Shanghai comes out of lockdown. We learned from Leland Miller, it's one big mystery. It's like S&P Global and macroeconomics. Nobody really knows. I think people understand. I'm a Pacific Rim optimist on this. I think they're going to come out and you're going to see a boom, boom, boom.
Again, Tom, what do you make of the leadership, though? Do you think that we've got the support for President Xi right now? Because I can't get any clarity, visibility on what's going on any of those topics.
I'm going to defer to international relations specialists on that. I listen most closely to Elizabeth Economy of the Council on Foreign Relations.
Brent crude 117, WTI 116, a turnaround in this oil market as we start to think about China and demand clicking back in, and maybe the potential for OPEC to do something they haven't done in quite a while, have a meeting longer than 15 minutes. Futures on the S&P up about 0.1% on the Nasdaq 100. We are unchanged. Euro dollar 107.11, negative 0.2%. From New York, heard on radio, seen on TV. This is Bloomberg. After all the choppiness we've seen over the last couple of weeks, this is pretty muted stuff so far. Tame. Futures positive by a little more than 0.1% on the S&P. On the Nasdaq 100, totally unchanged. The story for the equity market over the last week. Last week, massive squeeze. Big move higher by more than 6.5%. Stuart Kaiser of UBS about 20 minutes ago calling it a low conviction rally and pointing out, highlighting how investors use that rally to add downside protection. For the equity market for Citi, we talked about it already this morning. They don't think we've seen a bottom. They don't think we've seen a high in Treasury yields. Let's talk about this bond market, 2s, 10s and 30s, and focus on the 2-year, as the 2-year yield came in last month by about 15 basis points. 257.88 right now, up about 2 basis points on a session. Not just about the Federal Reserve here for the bond market, but also about the ECB, with Deutsche Bank talking up the potential for a 50 basis point hike from this ECB, Tom. Maybe not in July, but later in Q3.
Okay, so they do that. What happens? What happens the morning after?
The morning after where? To markets, to the FX market?
Beats.
They get back to zero, Tom, on the depot rate potentially. That's a big turnaround. We've been in negative territory since 2014.
I agree, but I just think it'll be good. It'll relieve uncertainty.
Do you think it will be good if we start to see the economic data go down? That's the problem the ECB has, Tom. It does not have the economy the US has.
That's true.
In the Eurozone.
Fair.
That backdrop for growth in Europe is really fragile. Does not have the strength in the labour market that the US economy does either. It's a very, very different scenario, Tom, I think.
It is. I'm just trying, John, I'm just trying to get a road trip to Vienna, and then on our way we'll stop at Frankfurt for ECB.
So Vienna on Thursday, and then you don't want to do the Jubilee? Throw that into the mix as well?
That's coming up at a meeting this afternoon as well, with the Jubilee
I look
starting
forward
tomorrow.
To the planning meeting a little
Me
bit
and Lisa
later.
will be in London because John will be on an extended super bank holiday weekend.
I think Bramo's going to give that a miss too, Tom. Can I get to the commodity market just briefly?
Please, the commodity markets.
Thank you. WTI very close to 120 yesterday. I think 119.98 at the highest. Then a Wall Street Journal report came out and suggested that OPEC Plus could drop the plus, be negative Russia, and ultimately have some kind of production deal. That's the speculation now. The speculation fueled by that journal report. Right now, crude off the highs of yesterday, but positive on the day by 0.9%. WTI 115.69. And for many of you, you don't see that price. The price you see is the price of gas, Tom, and that's pushing 470.
Yeah. Well, you know,
that's the problem.
That's where we are. I mean, we're elevated, to say the least, and many people say higher through June.
Is that your version of the Fed minutes?
Yeah, several.
Several,
Some.
a couple, many,
A few.
perhaps. That's the cross-asset price action. We've got a treat for you. If this wasn't enough...
This is a treat.
We've got some single names with Bramo. Good morning, Lisa.
Good morning. I just got to say, I love standing over here and listening to you guys try to figure out our road trip schedule. I will go where I am told. I'm happy to remain silent. What I'm looking at today is the partition between services in the tech world versus hardware. What we are seeing is services continue to be robust. Demand is there, despite some of the concerns about supply chain disruption. Salesforce earnings came out yesterday after the bell. They actually increased their projected earnings, their shares popping more than 9%. Amazon and Alphabet, the reason why I looked at those is because they also are big web services, cloud service providers. Those shares also gaining ahead of the market. Amazon up about 1%, and Alphabet, Google, we should call it, up about 0.4%. Tom, you were talking earlier about Tesla. I was also looking at Tesla shares after Elon Musk came out and basically said, if you don't come to the office 40 hours a week, and I mean the main office, find another job. Those shares down 0.6%. How much of an aberration is it for one of the representers, of the younger crowd, of the more modern, more millennial crowd coming out and saying this? To me, that was my takeaway from this, because that's unusual. Typically, it is the younger set that are more amenable to staying and working from home and being more flexible. How much does this go against that image right now that Elon Musk has been trying to go out there?
It's going to be an HR football for the next 12 months, no question about it. I should note the death rate from COVID today tipping again constructively in one survey under 300 deaths. That's a positive sign, Lisa.
Honestly, what does Elon Musk do that's not an HR football? That is one question. HP reporting, am I wrong?
Ooh. No.
Well,
Can I just clear
John.
one thing up about the millennials? I think the millennials get too much flack. It's the Gen Z. Gen Z doesn't not only want to come into the office, they don't want to work, Lisa. So I'm not sure there's a problem for Elon Musk over at Tesla, because they're probably not working over at Tesla.
You're worried about the cat mafia, worried about the Gen Z millennial
they do not want to work.
Honestly, you can make whatever argument you want. What it really represents to me is it cannot be bifurcated between young and old in terms of whether to come back to the office or not. It is idiosyncratic and it is specific to different cultures. And I think that seems to be one takeaway. HP reported earnings and they came out better than expected. Those shares are popping. Those are more more of the hardware. Basically, demand there is robust, which is interesting, but the supply chain disruptions have been an issue. And Hewlett-Packard Enterprises, HPE, that is the service side reporting after the bell. Those shares gaining with the anticipation that perhaps they'll provide something of a sales force.
Lisa, thanks so much. This is not a small matter. Lean forward and listen, Global Wall Street. There's a guy up in Connecticut, runs a small shop, who says cash is trash. Deborah Cunningham joined Federated when she was 12 years old. She's been doing this forever. She is the absolute dean of global liquidity markets and CIO at Federated Hermes, CFA Pittsburgh, and the rest of it as well. And Deborah, you go after Mr. Dalio and you say cash is an asset. Discuss why cash is not trash.
Well, first of all, I want to know how I can get in on the trip to Vienna.
Very
Please
good.
Include me in those emails.
We will.
As far as the cash markets at this point, as you mentioned earlier, we have been in a zero yield environment for the better part of 14 years now at this point in time. It's not a healthy market. 17% isn't healthy, but 17 basis points isn't healthy. We are now getting back to a point from an economic standpoint where we have an inflationary environment that is above the bare minimums, 1.5% to 2.25%. In that environment, we need short-term yields that are above that, and we are getting to that end result. As such, your cash is now a valuable investment that no longer is just there earning your earning safety and a minimal return. It is now not only earning safety, but also earning a viable return above where the inflationary rate is. We're getting there. We're not there yet. But certainly above, sort of the zero bound where we have been locked for a very long period of time.
And the heritage of this, folks, with the federated funds basically is a generalization. They invented the money market fund. There's some that would quibble with that, but they've been doing this and owning the high ground on short-term paper for years. Deborah Cunningham, talk to Lagarde and the ECB, as John and I were talking about. Should we fear these initial rate rises from any major central bank?
Well, I do think the ECB, as was mentioned before, has some unique issues going on with it. Certainly Brexit, complicated, and was a factor that led into some of the shortcomings of both the UK economy as well as the European economy in broad terms. So I think that's a factor that still has to be dealt with in a way that we are not subjected to here in the United States. Having said that, when you look at those economies, yes, they're not as vibrant, they're not as fulsome, and certainly from a labor market perspective, they don't have the same, numbers that we have along those lines, the same strengths that we have. And as such, there are more challenges. And yet they should not be in a negative interest rate environment. They should be at a point where there is cash, there are cash earnings there as well. The economies, for the most part, are not in any kind of danger of going into a recession. Not a large growth environment, but when you're looking at sort of steady and sure, you may see some setbacks as you go from -5 to 0 to +5 to 1, but that's part of what needs to happen in order to get out of I think part of the malaise that they have been in addition to Brexit, has been the negative rate environment, where there has not been healthy fixed income alternatives.
Deborah, just real quick here, I'm wondering whether you're actually seeing investors respond to this idea that cash is not trash, that it's a viable asset class in its own right with real yield. Is that something that you're seeing create a shift away from riskier assets back into cash for the asset value?
Yes, it's out of riskier assets, absolutely. It's also out of bank deposit assets because those don't follow the natural market rates. They're an administered rate, and so they remain in that zero bound for the most part, for most banks who don't want deposits. And it's certainly something that I think is a welcome alternative for investors that don't want to take on a lot of risk, want to maintain a lot of liquidity, keep their powder dry, yet still earn a return in the process of keeping their cash invested.
Deborah, looking forward to your appearance in Vienna. Thanks for being with us. Deborah Cunningham there at Federated Hermes. Lisa, yields up on the front end by 3 basis points this morning. Let's call it close to 260.
Well, but this really presents a conundrum, right? Because if investors start to put their money into cash, does that indicate that they're basically betting that inflation is going to come down? Because on a real basis, they're still not getting yield. So is cash really preferable to bonds that are yielding more? Is it preferable to riskier assets that are a better inflation hedge? It's a very tricky moment, which is the reason why cash itself is polarizing for the likes of Ray Dalio, as well as Deborah Cunningham.
Where else do you put it? Right now, you're going to face the relative loss versus inflation or the absolute loss in capital depreciation because markets get absolutely hammered. And they have been over the last few months. That's the problem.
And this is one reason why people keep going into commodities. And again, why a lot of people are saying it's surprising that commodity prices aren't even higher, given that that has been the main inflation hedge for so many investors.
Well, they're pushing hard this morning, Tom. 115.80 on WTI.
Yeah, I'm going to watch it. 117 on Brent crude is maybe what I'm watching more, the global price of oil. And John, you look at the peripheral distillates as well. I'll get it out. The distillates as well, like diesel. And the answer is we begin June with a serious hydrocarbon angst.
And looking potentially maybe at some downside surprises in the data. That's what we've started to see recently. Lisa talked about that yesterday. It's such a good point. It's starting to build, which is why for some people who believe this Fed takes a pause, they take every single downside surprise and say, you know what, that validates my position. That's what the Fed's going to do. If the Fed keeps pushing forward, that's where the pain's going to be. That's where the pain's going to be later this year. From New York City this morning, good morning. Bill Dudley, the former New York Fed president, coming up on this program very shortly.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. Ukraine will get advanced rocket systems and other weapons from the US. President Biden made the announcement in an article published in the New York Times. The rockets will allow Ukraine to hit targets up to 15 miles away. The US says Ukraine has promised not to attack targets inside Russia. In the UK, consumers are being urged to brace for inflation getting worse before it gets better. The British Retail Consortium says that fresh food prices are now rising at their fastest pace in a decade. It says fresh food rose 4.5% in the year that ended in May. China is planning for years of COVID zero, with testing sites on almost every corner. Tens of thousands of lab testing booths are being set up across the country's largest and most economically vital cities. The goal is for residents to always be just a 15-minute walk away from a swabbing point. Shares of Salesforce are rising today. The company raised its annual profit forecast, a signal that demand for business software is holding up despite a broader downturn for major tech firms. Salesforce co-CEO Mark Benioff says that so far the demand environment remains strong. And the richest person in the world doesn't appear to think much of working from home. Elon Musk apparently sent an email to the executive staff at Tesla with the subject line, "Remote work is no longer acceptable." He wrote that anyone who wishes to do remote work must be in the office for a minimum of 40 hours per week or leave Tesla. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
The economy is already slowing. 50 basis points may not be doable as we move into the fourth quarter or even later in the third quarter. They can resort to balance sheet reduction at a faster pace, which will provide nice upward pressure to the longer end, or at the very least, provide a floor to longer rates.
That was Lindsay Piegza, the Stifel chief economist from New York City. This is Bloomberg Surveillance with Tom Keene, Lisa Abramowicz and Jonathan Ferro. Futures positive 0.2 on the S&P, on the Nasdaq, up about 0.1%. Yields higher by 3 basis points, pushing 290, 287.85. Bill Dudley, the former New York Fed president, out with this morning. Tom, here's the headline of his new column. The Fed's mild inflation forecasts need explaining.
They do. They need explaining. It is a brilliant note. I'll have it out on Twitter. I'm sure John and Lisa will as well. William Dudley is the former president of the New York Fed and, of course, writing for Bloomberg. We're thrilled that Bill Dudley could join us this morning. Bill, buried in your essay on inflation is a single sentence on what it means for the labor market. April of 2020, a 14.7% unemployment rate. We were at 4% at the beginning of this year. We're now down to 3.6%. I need you to explain to our listeners and viewers why it's the Fed's job to move the unemployment rate, as you state, up above 4%.
Well, the labor market is the tightest basically it's ever been, and you can see that by the ratio of unfilled jobs relative to the number of people that are unemployed. That ratio is 1.9 to 1. In February 2020, it was 1.2 to 1. So we have a labor market that's unprecedentedly tight. The Fed needs to loosen that up, or wage pressures will accumulate, and that will keep inflation above the Fed's 2% inflation objective. The problem the Fed has is that in the past, it's been very, very difficult to push the unemployment rate up meaningfully without precipitating a hard landing. That's what the Fed's going to try to do this time, but it's extremely difficult to do. And they haven't really been as forthcoming, I think, in their forecasts as they need to be, because if you look at their last summary of economic projections, for example, the disinflation occurred almost immaculately. The Fed didn't really tighten very much. The unemployment rate didn't rise, yet inflation came back to the Fed's 2% target. And it really begged the question of what caused inflation to come down. I think the way you get inflation down is you need more slack in the U.S. labor market. That's not a friendly message from the Fed, but that's what's necessary at this point.
And Bill, just to put some numbers on that, as you say, core PCE year end for the Fed 22, 4.1%, 23, 2.6, and unemployment 3.5, and then 3.5 again. And many people have been asking the same question. Bill, you know the chatter right now, it's this conversation about a pause in September. How are you interpreting some of that conversation?
I wouldn't put too much stock on it. I think what's happening is the Fed's pretty convinced that they need to go to something close to neutral, and expeditiously is the way that they put it. And so that's what they're doing. The notion that at some point they're going to take a pause and look around, of course that's going to happen at some point, but it's going to be driven by the economic data. I think that the economy is going to have enough momentum to keep the Fed will keep going into the fall. The market's priced to a peak in the federal funds rate of 3%. I think we're going to get to there pretty easily, and the Fed will probably actually have to push beyond that ultimately.
Bill, what kind of unemployment rate are you looking for to indicate perhaps a tightening, a loosening in the very, very tight labor market?
Well, the Fed's own forecast is that a neutral unemployment rate consistent with 2% inflation is 4%. So I think you need to get the unemployment rate up to at least 4%. The fact that we have so many unfilled jobs suggests that maybe the unemployment rate consistent with 2% inflation is even higher than 4%. So I think we need to at least get to 4%. And that's the problem. It's difficult to do that without precipitating a full-blown recession.
Bill, did you take any message from the fact that President Biden met with Fed Chair Jay Powell yesterday, that there was this focus on the Fed being the main driver for what happens with inflation going forward and the politicization of the Federal Reserve?
Well, I think Biden was actually not politicizing the Fed. He was basically saying the Fed's job is to control inflation, and I'm not going to challenge the independence of the Fed to do that. In some ways, though, he's putting the burden now on the Federal Reserve rather than on the administration. I viewed it as a political event, not an economic event. I don't think it changes what the Federal Reserve is going to do or what the Biden administration is going to do.
Bill, we had a one-off medical event, a pandemic of our lifetime. That got us out to 14.7% unemployment. Can we cut any central bank slack and have them extend out the x-axis and just take longer to get this done, to repair off of this medical event?
Well, if they take longer, the risk will be that inflation will stay higher, and then that will start to get embedded in higher inflation expectations, which will make their job more difficult. The good news for the Fed right now is they're highly credible. Market participants expect the Fed will do the job and get inflation back down. Inflation expectations at the longer-term horizons are still very well anchored. If the Fed dawdles, then the risk is that inflation expectations become less well anchored, which will make it harder for the Fed to get inflation back down.
But is your view hardening, not softening, based on incoming data that this Fed funds might end up with a 4 handle and maybe not a 3?
I don't think it's changed too much. I mean, the good news is that the Fed has things in hand today in terms of market confidence, in terms of inflation expectations being well anchored. That's the good news. The bad news is I think people are understating how difficult this job is.
What do you make of this idea that they can target job openings, Bill? JOLTS data, which is a little bit dated. What do you make of that?
Well, I think their story is a quite an optimistic one, that they can tighten monetary policy sufficiently to reduce the demand for labor without actually pushing up the unemployment rate meaningfully. This is the tightest labor market I think we've ever had, frankly. And it seems to me if the labor market is tighter than it's ever been before, that makes the job more difficult, not easier.
Super hard. Bill, wonderful to catch up. Bill Dudley there, the former New York Fed president, on the path forward, and a really interesting piece on the Fed's inflation forecast available on Bloomberg.com and on the Bloomberg terminal on the Bloomberg opinion column. Lisa, to bring job openings down, to take out some demand from a hot labour market, to rebalance supply and demand, and ultimately not see unemployment go higher, that's the dream? Is it going to be real?
Right now, here are some of the issues right now, and I'm stuttering over my words because the uncertainties are just so monumental, not only with the economic trajectory, but the data itself, right? I mean, we saw last year the revisions to the labor market data came in much hotter than we had previously expected by the end of the year, so that all of a sudden the summer months did not look like a softening, did not look like we were seeing some sort of deceleration in how hot that labor market was. How much can we really look at these job openings as concrete? Some people say perhaps people are just listing 15 job openings because they're not getting enough applicants. I mean, honestly, there's so many people having their own interpretations of this, which is the reason why you get 5 economists in a room and you get 6 different opinions on the trajectory of where things are going.
Isn't that always the way? On the one hand this, on the other hand that, and on 5 different hands this, that, and this. This is from Delta. Just came moments ago, Tom. They see their second quarter revenue fully restored to 2019 levels. And this is what they said on the second quarter capacity. And I think it's the capacity numbers that keeps getting my attention from the airlines. 82 to 83% versus the second quarter of 2019. They had seen those capacity levels up to about 84%. We are all living that. If you're traveling at the moment, Tom, we are all living that.
I look at 2 prices. I look at the trip to Paris just as a gauge, and I also look, John, at New York to LAX. Delta Airlines, $800 to $8 economy. I can honestly say I've never seen that number.
Unreal. So expensive at the moment. The stock is up 2%. $42.50. Delta Airlines. The airlines are doing well, aren't they? For many reasons.
We're taking the
living
trip.
it.
The Biden administration has a very real problem here. They've got to get inflation down to a more comfortable 3%.
This inflation's really coming from everywhere.
We're going to be in that 3 to 4% consistent inflation level. And I think it's going to be for 3 to 5 years.
I think if inflation peaks, it will provide some relief.
I think the Fed is very optimistic that they're going to see lower levels of inflation, but they're not forecasting 2% inflation anytime soon.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene on radio, on television. Bloomberg Surveillance greets June. John, 1 year ago, Brent crude up 66% in 12 months.
What a turnaround, Tom. And look at the equities on the S&P 500. They're up about 60% as well. A massive move. And that's the place where the likes of Bank of America is still pretty comfortable, Tom, taking that exposure in the equity market in that industry specifically.
Everything we do, John, we talk about the Fed, the president, everything, ECB, all of it is backed by a commodity foundation, which is a commodity boom.
And that's why a lot of people, Tom, think this Fed has got a job to do, and that's to take out demand from this economy. As Bill Dudley, the New York Fed, the former New York Fed president, said just moments ago on this program, the challenge for this Fed is so difficult. How do you take out that demand from a hot labour market, rebalance the labour market, supply, demand, and, Tom, do that without unemployment climbing? That's in their forecast, 3.5% on unemployment this year, again next year. In reality, that is so difficult.
Jobs from 14% unemployment down to 3% unemployment. We're back. Maybe Bill wants to model out to 4% unemployment. What's the risk, John, that all of a sudden 4.1% becomes 5.1%? That's unacceptable to Americans.
And then what does the Fed do, Tom? Are they still hiking? I doubt it. I doubt it, because CPI is going to be going in a very different direction, or maybe it won't. And that's the fear. You end up in this situation where inflation persists and growth starts heading lower. What does the Fed do in that world, Tom?
On June and on a June reset out front of a mid-year reset, Lisa Abramowicz, it's real simple. Bonds say all. What do bonds say on June 1st, 2022?
That maybe it's time to shift back after a shift in the narrative. Basically, we saw people saying that the Fed was going to go really quickly and actually get out ahead of expectations. It was who could out-hawk each other in terms of how much they could up their projections for Fed rate hikes. Then you had the Fed pause, right? Raphael Bostic sort of took the mantle on that. And now it's shifting back again that the Fed will have to be more aggressive, with Andrew Hollenhorst of Citigroup coming out this morning and saying basically all indications show that inflation is not slowing. And without inflation slowing, you're not going to get that pause.
We pause for the surveillance sports report right now. John, Rafa Nadal, this Friday, 2 days from now, 36 years old. I'm sorry, it's a huge deal, underreported in America.
Seeing him smile yesterday, Tom, at the end of that game after beating Novak across 4 sets. I think it was John McEnroe, that said years ago that beating Rafa in Paris at the French Open is one of the hardest things to do in sport across 5 sets. Tremendously difficult. And Tom, he's only lost in that event, I think, 3 times. 3 times across his career. Just unreal.
Across the span of June, we'll have to watch that. And, of course, the Red Sox are going to drag themselves back to 500 baseball.
I thought we didn't talk about the Red Sox, Tom. I thought that was done.
It's too painful. We'll move on from there. Futures up 15, Dow futures up 170. John, June, in honor of the Queen, we quote the Dow often.
Do we? Does the Queen like the Dow? Is there a price target at Buckingham Palace we need to talk about?
She follows it every day.
Okay. Yield time by 3 basis points on a 10-year, 287.49. It's a quiet morning, Tom. Crude advancing 115, let's call it 60, up 0.8%.
I mentioned coal in Australia. I'm sorry, I'm watching some of these small items to see if copper turns around on the China opening. Brent Schutte joins us now, Chief Investment Officer, Northwestern Mutual Wealth. Brent, what are people actually doing with their money? You observe this across all of the conservative Northwestern Mutual platform. What are they actually doing?
Well, I think the good news over the past few years, people have actually saved money. And so one of the conversations that I think gets avoided quite a bit is that the consumer is in pretty good shape right now. So yes, gas prices are eating away at that, but overall the consumer remains in good shape. And I think that's going to help them get through this time period where inflation is high. But importantly, I disagree with the Citigroup message that you had earlier. I do think inflation has peaked. I think it's rolling over. I think that's already begun. And I think that's going to give the Fed the ability to not tighten the U.S. economy into a recession, which I think is the market narrative that kind of came out last week, but I think you'll continue to see in the future.
So, Brent, based on the rally of last week, can we learn anything about where the leadership comes from in this equity market that you're a little bit more constructive on?
Yeah, I mean, we've been pounding the table for value and things that are cheaper for the past year, and that's played out well. So you've seen a market dislocation because you've had an economy that is moving back towards what it was pre-COVID. You have monetary and liquidity issues that are moving back to pre-COVID, and the most expensive names have been repriced because you've repriced the bond market, and many of those names actually were stay-at-home stocks. And so if you've been in value stocks, you have not experienced near the downturn that you have in the more expensive stocks. And that's where we continue to focus because it's not going to get that much easier. It's still going to get tougher. But those cheap names give you a margin of safety that we would still want to own.
How big is the range of outcomes, Brent, if you're wrong, if the Fed doesn't pause, if frankly, yes, inflation has had a mechanical peak, but it doesn't come down all that much? Is your thesis completely wrong, or do you just have to tweak it around the edges?
I think more so tweak around the edges. And the good news is that we build a diversified portfolio. And so we've owned things like commodities for much of the past year and a half, 2 years when it's been very unpopular to own. We've continued to own those because we did believe you would actually see what you're seeing today, which is an inflationary environment that is much different than the past. I have not believed that inflation was dead. I just thought it took longer to get there. And I did believe all the things that happened during COVID would lead to where we are today. We also own TIPS. We've actually moved out of that position right now because we do believe inflation's coming down. I guess the good news is that I think it'd be tweaks around the edges, but there certainly is a wide range of outcomes. And the most complicating issue is the Ukraine-Russia war, which quite frankly wasn't on the radar much before the past 2 or 3 months.
So interesting that you say that. I want to go back to what S&P Global came out with earlier this morning, where they basically withdrew projections for 2022 forecasts, even though this is a company that tracks other corporate balance sheets to get a sense of where things are going. What are you tracking, Brent, for some sort of compass at a time of such uncertainty?
Yeah, I mean, I think the big news is what happens with inflation. And certainly if you take a look at inflation and where it's been on the good side. That good side of the economy had pulled forward demand. Think about those earnings that we all worried about last week with, I think it was last week, Target, Walmart, Amazon, things of that nature where they rebuilt their inventories because they thought demand was here to stay, and that actually is now shifting. And so they're caught with heightened inventories. They're having to lower prices. And so if you kind of put all those together in a nice mosaic, I do think you will see inflation fall, which is the biggest question that's out there that people have is what will happen with inflation? And then secondarily, what will the Fed do about it? And you mentioned in your opening that the Fed talked tough. So people are worried about these rate hikes, but they're already priced into the market. It's what happens from here. And that's where I think there's some room for the Fed to go shallower and just a bit slower than what's imagined.
Brent, in the great moderation, we've had pension funds with a true actuarial assumption come down. They've brought that bogey down. And we've also had it in our heads what are we going to take out of retirement plans per year? Are we at a point where you now need to increase your actuarial assumption or be able to increase what you take out of a portfolio?
Well, I mean, I think that I understand the question. I think if you're looking forward, I do think returns will be less than they have in the past. I mean, we've had a pretty good decade, even on the back of bad economic growth. I think in the future, you're going to actually have lower returns because the market, at least the majority of the bigger part of the market, is more expensive. I just think that people need to look overseas and in other places that haven't worked quite so well over the past few years. I think there's actually a positive story building where those equities are much, much cheaper. I know that people get tired of waiting for valuation to work, but I think there's probably a bit of a catalyst coming that will actually propel those areas of the market higher.
Brent, that screams China, doesn't it?
Yeah, I mean, that's an interesting commentary because you have to add geopolitical risk on top of that. But certainly places like international stocks trade at 12 times earnings, and those earnings are near levels they were 10 years ago. Contrast that with the U.S., where we're still, at 16.6 times forward earnings, which is not cheap, at least in the larger parts of the market. I think you're looking at something more like post 1999, 2000, where other parts of the market do better than the part of the market that did well during that time period and was quite frankly overvalued. I think you need to look elsewhere right now.
So, Brent, are you saying that maybe the S&P might be mechanically challenged at the index level for quite a while, given its weighting to big tech?
I think so. And I think that was the message post 1999, where you had parts of the market that were overinflated. They had been brought forward by demand. They had done well. Investors had bid them up to levels that were probably a bit excessive. And then you had other parts of the market do quite well, and it wasn't a lost decade for those parts of the market. I think expectations are still so low outside of those parts of the market that everybody wants to talk about that you have the impetus for a push higher in the coming years.
Fascinating, Brent. Truly, thank you, buddy. As always, good to catch up. Brent Shitty there of Northwestern Mutual. Tom, a more constructive view in some places, but that last point, just on how challenged the index level might be because of the weighting to big tech, that's where the advantage has been for American equities at the index level to allocate to that passively. And some people suggesting that may be where the disadvantage is for years to come.
Well, I agree with the passive weighting debate there. We've seen that before. And of course, years and years ago with the huge energy overweight, I'm going to say 30 years ago off the top of my head. What I found really interesting there, John, is once again, major shops saying we've got to at least study, if not act on international investment. And I'm so old-fashioned here, John. To me, the overwhelming factor there is you need a weak dollar to make it happen. And we just flat out through the month of May didn't see that.
Are you saying that's a symptom, Tom, or a driver of?
Driver
you get
of.
the weak dollar because it's a symptom, you think it's a driver of.
Driver of. And, I defer to Ibram Mabari or George Saravelis to tell me I'm wrong on that. But I'm looking at 102 DXY. Maybe the yen's giving me some love here out past 130 would be interesting. But euro? I mean, come on. If they pop 50 beeps like Deutsche Bank says, you're going to get a weaker euro? I don't think so.
Hey, TK, that's the problem, though. Lisa's mentioned it many times. I have too. Can you say with conviction that higher rates of the ECB means a positive euro story or a negative one?
That's the drama that keeps us employed.
That's going to keep things really entertaining at the ECB next week. That's why you should stay tuned to full coverage of a non-snoozer presser with President Lagarde. I can't even promo it, seriously. Yields up 3 basis points, 287.31. Equities positive, 1/3% from New York, heard on radio, seen on TV. This is Bloomberg Surveillance.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. Treasury Secretary Janet Yellen says she got it wrong last year on inflation. Yellen made the admission in an interview with CNN. Last year, Yellen predicted that elevated inflation wouldn't pose a continuing problem. Now she says she didn't fully understand the circumstances. Meanwhile, the Federal Reserve is about to deploy a second tool to curb inflation alongside higher interest rates. It will begin shrinking its $8.9 trillion balance sheet. Officials don't know how effective it will be. They say it should cool price pressures by tightening financial conditions. The U.S. is ramping up military support to Ukraine. President Biden says he'll give the Ukrainians advanced rocket systems and other weapons that will allow them more precision in attacking Russian targets. The weapons will let Ukraine hit targets as far as 50 miles away. The U.S. says Ukraine has agreed to not use the weapons to attack targets inside Russia. And the city of Shanghai reported its fewest coronavirus cases in 3 months. That came on a day when residents celebrated an end to mandatory home isolation for most of the city. Shanghai saw just 15 new infections Tuesday. That is a dramatic drop from the peak of more than 27,000 a day back in April. And Delta Airlines is back to where it used to be. The carrier estimates that second quarter revenue will be, quote, fully restored to 2019. Capacity is expected to be about 83%, just 1 percentage point off the 2019 figures. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month and all year long.
You have to just look at the cost structure of the industry. You have to look at where new production is coming and where it would be coming even if we didn't have $123 Brent. And I'd say it's more in the $70 range than it is in the $120 range.
Ed Moore's taking the other side of the trade, the Citigroup Global Head of Commodity Research from New York City this morning. Good morning. Equity futures look like this on the S&P. Positive 1/3% on the Nasdaq. A similar amount, up by 0.32%. Yields higher by 3 basis points, 287.31 on the 10-year. And crude higher by 8 or 9/10%, 115.66. Here's a note from our next guest, Tom. Back in April, we lampooned a Washington Post opinion writer for their obtuse observation that if it were not for that darn inflation, Biden's economy would be extraordinary. The writer went on to say that Rubin's logic was as intellectually robust as us saying that if our grandmother had wheels, she would be a bus.
That can only be the wonderful Stephen Schork, founder and president of the Schork Group, John. His note, folks, is just the breath of fresh air within the petroleum business. Is Ed Morris of Citigroup, who we just listened to, talks about the macroeconomics of the moment. Stephen Schork is hyper-defined. Steve, let me go to the single sentence of your note. 99% of us are simply getting poorer in this commodity surge. Will that trend continue?
Absolutely, Tom. So real disposable income, what we have to spend, has fallen in 10 of the past 13 months because of runaway inflation. Inflation, by the way, that all the smartest people in the world spent the better part of last year doing yeoman's work, making fools of themselves every single week, saying that, oh, inflation is transitory. Yes, if I don't have to eat, if I don't have to put the lights on, if I don't want it to stay cool this summer, yes, right. Inflation is not a problem. But what we're seeing now, Tom, it always comes down to commodities. And what we're looking at in the energy industry, well, we know that story. But what most people, especially the ESG crowd, or the people that are taking the war against natural gas, is the war on natural gas is a war on the American consumer. So what it has done to fertilizer prices, of course, natural gas is a key feedstock into synthetic ammonia fertilizer. So we're putting fewer seeds into the ground this spring, which means we're going to take fewer crops out of the ground in the fall. So the inflation has not peaked. Right. I mean, it's peaked on the core level, but as far as energy and food, which is all dealing with us all, inflation has not peaked. And Tom, this is the problem. Runaway inflation at the gas pump and at the grocery counter has been the lead indicator for recession of the last 6 recessions in the United States, beginning with the
Okay, Steve, I want to go to the hyper detail of your note and your true expertise on distillates. Do you have any optimism we're going to invest given these higher prices?
Well, as Winston Churchill once said about America, we always make the right decision after we've tried every other decision. So I'm not quite sure we're there yet. Here on the East Coast, of course, what has happened? Well, over the past 3 years, we've cut our refinery capacity by 40%. So now gasoline production on the East Coast has held steady. But when you cut your capacity to make things out of crude oil, something has to give. So while we've maintained the status quo on gasoline production, diesel production has fallen 40%. So right now, diesel stocks for the first time ever in the East Coast are below 9 million barrels. So we are looking at a dire situation in the diesel market, but we're not quite there. The smartest thing the Biden administration could do with regard to the energy crisis here in the United States is rescind the Jones Act. The Jones Act requires all interstate commerce, waterborne, be tagged on American flagged vessels. Well, guess what? We don't have enough American flagged vessels. You need to rescind the Jones Act, allow diesel, gasoline being manufactured in Houston to put that on foreign flagged vessels, to bring it around the tip of Florida and get it into the East Coast. That is the smartest thing to invest in a short-term fix.
Yeah.
Regard to the longer-term fix, no, there is not a political will at this point to invest in fossil fuels. Thereby, the long-term structural imbalance between supply and demand will remain. High prices, therefore, have to remain, Tom.
Stephen, have you been surprised by how little pushback there has been on consumers with respect to reducing spending? There has been a reduction in real spending if you look generally at the trend. However, overall, they continue to spend more, even as you see new records every day of gas prices.
Yeah, absolutely, Lisa. Now, the calculus there has changed because we have substitutes in the market, i.e. EVs. So it used to be consumer spending would drop off and gasoline prices, national average, hit about $3.60, $3.80. Natural gasoline, gasoline on the NYMEX now is trading over $4 a gallon. So the AAA average right now is about $4.60 national average. Given where futures are trading now, by the 4th of July, gasoline prices will be another 20 cents higher, $4.80. I do have to believe, even though we've never had anything to mark this against, we will start to see that. But to your point, yes, that it has been one of the positives. Consumer spending came out last week, stronger than expected. But the problem there is that we're waiting for the other shoe to drop because the personal savings rate plunged to 4.4%. We are well below the 30-year non-recession mean on savings and the 60-year non-recession mean on savings. In fact, savings rate is at the lowest point since 2013. So the bottom line, Lisa, is we've run out of all the stimulus money. Americans are dipping into their piggy banks. It costs more to drive to your picnics, to go to the beach, so forth. So in the next quarter, yes, I do expect to see consumer spending to tail off, which of course is a problem, given that consumer spending is 2/3 of the U.S. economy. And therefore, this is why I'm still comfortable in saying if the United States is not currently in recession, given these food costs, these energy costs, our falling income, we will be in a recession within the next 6 months.
Stephen, usually I say thank you, but that one was a little bit depressing. Stephen, thank you, though. Anyway, Stephen Schork there of the Schork Group. Thank you, buddy. Good to catch up. And right on cue, Goldman at the gate, cutting price targets on Ford, GM, Tesla.
Wow.
They say this, Tom, supply chain troubles in the near term, weaker demand in the immediate term. They go on to say key metrics that correlate with auto demand, housing data, consumer sentiment, throw in PMI metrics, the ISM, consumer demand data points, they've weakened. And they're removing those price targets and cutting them to 14 from 18 on Ford, Tom. GM, 46 from 59. Still punchy price targets on the likes of Tesla, 1,000 from 1,200. But the direction of travel of the story there, Tom.
Exactly. The direction of travel resounded by Itay, my colleague today over at Citigroup, John. He was a little more optimistic than that, but he made it real clear there's some intermediate trends in autos which are challenging.
And those challenges look to come through the auto market. Lisa, if the Goldman team are leading us towards the truth right now, and that seems to be where things are heading.
I do wonder whether the macroeconomic headwinds that are suddenly so surprising to executives come from China, and frankly, that the extent of the lockdowns perhaps weren't known to such a degree.
Are you questioning the surprise in the surprise? How surprised we should be about the surprise?
It's a toxic
derivative surprise.
It's a what, Tom?
A mushy surprise.
A mushy toxic.
A sea of mush, as you called the English breakfast a little bit earlier this morning. I've not forgotten.
I actually really enjoyed it. It was great.
Live from New York City this morning. Good morning and hello to the month of June. Goodbye, May. Futures positive about 0.5% on the S&P, on the Nasdaq 100 up by 0.47%. Yields just a little bit higher. They bleed higher 3 basis points, 287.31 on a 10-year, and crude all over the place yesterday. Nicely positive, then whipsawed by a Wall Street Journal report, which led some people to believe maybe we can get some kind of output deal without Russia involved. Crude lower, then ultimately positive again, up by 1.4%. TK 116.28.
There it is right now. John, we got to note the market's turned around. I mean, we got a lift to the market.
It's nice. A half of 1%.
VIX under 26 still gets me going from 31 here.
Should we call it a quiet move, Tom?
It's
nothing
quiet move.
overly dramatic.
It's nice. Anytime a
It's
move
nice.
in the equity market is called nice.
It's a nice move.
It just shows how long it's going to
Ramo,
last.
Give the Bulls something. It's a nice move. Just give
so
them
sweet.
something.
It's like
You know,
vaguely
give them some
condescending.
crumbs, all right? It's been a tough year.
This is a joy.
Is it?
Can we move on?
This is a joy. I'm
This
with
is
you.
a joy.
This is a
Mickey
joy.
Levy's going to hang up. We're gonna move on
I
here.
think other people might too.
Long ago and far away, out of the crisis, there was analysis like Chair Yellen getting, inflation wrong in the last couple of days, where a group of people said, beware inflation. And the coined inflationistas maybe got it a little wrong 10 years ago. Mickey Levy was part of the Shadow Open Market Committee, of course, his work with Bank of America and now Definitive at Berenberg Capital Markets. And right now, Dr. Levy, things have changed. It is people who worry about inflation with all the heritage of Alan Meltzer, Marvin Goodfriend, and others of the Shadow Open Market Committee. And now you are amid high inflation. How do you interpret the ancient worry of inflation now that we're amid real, tangible inflation?
Well, Tom, I mean, you just feel it everywhere. The inflation was generated in a classical manner, just excessive monetary and fiscal stimulus generating too much demand. At the same time, you had supply constraints. And now you just feel it. It's an inflation tax, and you feel it imposing itself on real purchasing power. And so the question is, how embedded has the inflation become in wage and price setting behavior? Once again, and the Fed has a long history of this, the Fed has waited too long to exit from its easy policies,
right.
And inflation's come back. And now the question is, will the Fed be able to weave this fine needle of raising rates just enough to slow the economy to take the edge off inflation without tightening too much? And it's going to be a challenge.
Are you using here conventional economics, including targeting a la Taylor rule and other fancy mumbo jumbo? Or Mickey Levy, is this so original how we got here and where we are now that you've got to be as data dependent as Jerome Powell?
Well, yes, you have to be data dependent. I mean, it was almost as if last year the Fed was deaf to the data. But now the difficulty is monetary policy, works with a lag. So, and the problem is you have this deeply negative real funds rate, and the Fed doesn't know how much it needs to raise rates to dampen things because, some of the higher inflation is due to supply constraints. And it's a guessing game for the Fed as to how much they need to raise rates to dampen demand. Now, it definitely has to raise rates probably more than the Fed funds futures is suggesting. But we're in this very difficult situation. Tom, the other thing I would add, I hear so many people talking about, recession now. And if in fact we're on the verge of going into recession, then this expansion peak is very, very different than all other expansion peaks in its economic and financial characteristics. So we could be entering a gray area, and I caution people about thinking in binary terms, either recession with a capital R or continued economic expansion. It could be a very difficult to define gray area that we're entering.
Who's further behind right now, Mickey, the ECB or the Federal Reserve?
Oh, the Federal Reserve is core inflation in Europe is well below that in the U.S. Europe faces a whole host of other issues, not just high inflation, but it's very low potential growth. But in the U.S., whatever measure of inflation used, core inflation is much higher. And if you look at different measures of inflationary expectations, the Fed has a difficult task ahead of it to raise rates. enough to interrupt that wage price feedback mechanism.
Do you buy the pause argument that a lot of people are eschewing, basically saying the Fed will take a break from raising rates 50 basis points, maybe perhaps come September, and sort of take a look at how the effect is really trickling out into the economy?
Lisa, that's a great question. Okay, so the Fed dithered through last year, and now it's all excited that it needs to hike rates aggressively. And the question is, not only will they raise rates enough, but will they have the resolve to really lower inflation? And there, it depends critically on the economy and particularly labor markets. If, as the Fed hikes rates, labor markets remain okay, the unemployment rate increases just a touch, but not that much, then the Fed will continue to hike. But I wouldn't be surprised if, not this September, but later in the year, early next year, when the unemployment rate starts moving up, the Fed, comes out with a statement saying, oh, we have to be balanced on our dual mandate, and it kind of backs off from things.
Right. Mickey,
we're in a difficult situation.
Mickey, Chair Yellen came out yesterday and said she was wrong on inflation. What did the people get right who pushed against transitory? Let them take a victory lap right now. What did they get right? Dudley, Alarian, Levy, Summers, the rest. What did they get right?
That all you needed to do, Tom, was look at broad measures of aggregate demand, like nominal final sales to domestic purchasers or nominal GDP. It was accelerating sharply last year, which was completely inconsistent with what the transitory camp said, that it was just supply constrained. And so basically the root of that was we had this unprecedented amount of deficit spending that was, and the bonds the Treasury issued were largely purchased by the Fed, purely classical. If you just put on simple standard fiscal policy multipliers on what the fiscal authorities did with deficit spending, you would have predicted a surge in aggregate demand. And when the data started showing that, it's really quite striking how the Fed and the Biden administration were in complete denial.
Mickey, groupthink. It's been a problem at the Fed for a long time. Mickey, have we fixed it?
This is truly a wake-up call. The Fed has just gone through so many unforced errors that it really needs this wake-up call. We hope it learns from the current situation, but I think there still is too much groupthink. The big Furbus macro model that the Fed uses has not been working, but the Fed still talks about it as if it's working. The Fed really needs to think more broadly. I think it learned something from this, but I still worry that it just relies so much on its own discretion and does not use a more rules-based approach to monetary policy.
Mickey, awesome to catch up. Mickey Levy there.
There's a Mickey we know.
Berenberg. Mickey, fantastic. In fact, the Taylor rule was coming up there, Tom.
I think that's where he was heading.
Just a little bit.
A little bit. Folks, this is what we try to do. Different opinions all the time. John, a doozy from J.P. Morgan moments ago.
Give me the number, Tom. Give me the number.
Christian Malik, who joined us in London. And, of course, there's people that disagree with the J.P. Morgan view. See Ed Morris over at Citigroup. But they reaffirm on the dynamics between Russia and Saudi, and that Saudi, quote, will keep the powder dry, that you get a risk towards greater than $150 a barrel.
139 is the high of the year. That was the 7th of March. Tom, trying to convince people that we haven't seen the high of the year on crude.
Oh,
can you imagine?
There's nobody out there.
150 plus?
Well, it's the way they walk through it. And, I want to make clear, this is not some throw a dart at the dartboard.
No, sure. There's a lot of work on capacity that's been done here by Malik and the team.
A lot of work on that, but it's about unforeseen events. And Christian walks through, if Russia blinks, what does Saudi Arabia do? The usual ballet of OPEC+. Plus. Of course, if we went to Vienna, we would have a better knowledge of this, John.
Brammer would like to talk about this nice move in the market this morning. At least the future's up 0.5%.
It's so nice. It's so
it's
sweet.
A nice move,
it's
isn't
just,
it? The Nasdaq
honestly,
up 4/10.
Okay, look,
market,
the fact
Lisa.
that we're getting,
Equities.
thank you, I appreciate that. The fact that we're getting a lift, though, is notable, especially given the fact that people are still seeing interest rates go higher. I honestly can't make much of any of these moves because honestly, they'll be different in a half hour.
Of course they will.
I mean, it's like, it's
It's
great.
always the way,
nice.
isn't it?
I know,
It's always
but
the way.
it's all over the place these days. So how much conviction can we really have?
We said
Nice.
it when we started the program earlier this morning. When we look back at May, did it feel like a month where we were flat on the S&P 500, up 0.01%? Anything but.
You know, honestly, uncertainty is deeply unpleasant. Everyone feels that. And that is what we have right now. And it's profound uncertainty. You see that in some of the fluctuations and, frankly, the single name moves in the wake of certain earnings reports. How do you parse that into an index level call is beyond me.
John, we're uncertain about our uncertainty.
We are. It's very philosophical.
It's the pendulum of fixed income only.
There is a conversation you do not want to miss. It takes place in a couple of minutes' time. It's Lisa Abramowicz sitting down with Howard Marks of Oaktree. Don't miss that. It's coming up very shortly on Bloomberg TV and on Bloomberg Radio. Futures up 0.4%. It's a nice move. Bramo said so. From New York.
No.
This is Bloomberg.
You can't put that on me.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. Ukraine will get advanced rocket systems and other weapons from the US. President Biden made the announcement in an article published in the New York Times. The rockets will allow Ukraine to hit targets up to 50 miles away. The US says Ukraine has promised not to attack targets inside Russia. European Union ambassadors are set to approve the bloc's sixth package of sanctions against Russia. The final compromise targets Russian oil transported by ship, but it spares crude delivered by pipeline to satisfy Hungary's demands. In the UK, consumers are being urged to brace for inflation getting worse before it gets better. The British Retail Consortium says that fresh food prices are now rising at their fastest pace in a decade. It says fresh food rose 4.5% in the year that ended in May. China is planning for years of COVID zero, with testing sites on almost every corner. Tens of thousands of lab testing booths are being set up across the country's largest and most economically vital cities. The goal is for residents to always be just a 15-minute walk away from a swabbing point. In New York State, Governor Kathy Hochul and legislative leaders pledged to raise the legal age to purchase an AR-15 assault rifle to 21 years old from 18. They'll also say they'll pass a package of measures to tighten gun laws this week. Officials cited the recent mass shootings in Uvalde, Texas, and Buffalo. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
We're in an environment now which is very different to the one we've seen in the last couple of decades, when both commodities and labour were easily available and relatively cheap. And now we're in an environment, probably structurally, where both commodities are becoming more scarce, more heavily contested and competed for, more expensive, and labour as well.
From London, Peter Oppenheimer. He is Chief Global Equity Strategist at Goldman Sachs. His views on an equity market and the hallmark here of a 1st June day is the uncertainty that is out there right now, which means everyone reading Howard Marks leans forward and reads a little more carefully. He is successful. He is a philanthropist. And Lisa Abramowicz, we know for certain, is a member of the Board of Trustees of the Metropolitan Museum of Art. The Met Gala is Howard Marks' fault.
Yes, well, we actually very much appreciate it for us who have spent many, many hours at the Metropolitan Museum of Art. There also is this question of investor psychology, and Howard Marks is co-chair and co-founder of Oaktree Capital. And frankly, one of the co-founders of the entire distressed debt market, really understands how psychology can drive what is perhaps the best philosophy going forward. And he writes these fabulous memos from time to time, as late as Bull Market Rhymes. Howard, thank you so much for being with us. I want to start with trying to understand investor psychology. And as a student of history, where are we right now in terms of bullish or bearish?
I think that attitudes were quite bullish prior to a few months ago, with the exception of a brief respite during the pandemic. We've been in a bullish climate since the end of the global financial crisis in '09. Not wildly bullish, certainly not what I would call euphoria, but optimistic. And that has been crimped now. A lot of the big name stocks are off 50, 70, 80%. The whole market is off, probably 15% from the high. So I would say that attitudes are more balanced today. When there's euphoria, when there's optimism, when there's greed, when there's risk tolerance, and so forth, that's a very difficult climate for the value investor to find bargains. So we're happier today than we were 6 months ago. I don't know if we're going to be happier 6 months from now. That is to say that the bargains will be more pronounced. But at least, as they say, the bloom is off the rose.
At a time of such incredible uncertainty, how do you position seeing value now, but also preparing for seeing more value in 6 months?
One of the 6 tenets of Oaktree's investment philosophy, which we established when we started in April of '95, and I've never changed a word, and I believe in thoroughly, is that we're not market timers. And that means mostly 2 things. We never sell to raise cash to prepare for a decline. And we never say it's cheap today, but it'll be cheaper in 6 months, so we'll wait. If it's cheap today, we buy it. If it's cheaper in 6 months more, we buy more. And I think that works much better than an assertion that we know where the market will be in 6 months.
This is really important at a time when so many pensions and institutional investors have been shooting for that 7.5% to 8% bogey. We talked about that extensively in the past 5 to 6 years. This idea that seemed completely unachievable in an era of quantitative easing. Suddenly, high-yield bonds have an average yield of more than 7%. Is this the best period that you have seen for pensions to actually hit their bogeys for more than a decade?
Well, I think that's right. Well, of course, many have hit their bogeys. It just didn't look in advance like they would, but the stock market and many other things have surprised on the upside for the last 10 years. But now, as you point out, one of our big activities is high-yield bonds. And a year ago, they were yielding in the 3%. One deal was even done in the 2s. That's not a very high yield for high yield. Today, as you say, they yield in the 7s. So a pension fund that needs 7 or 7.5 can make use of high-yield bonds. And everything, see, when everybody gets concerned when prices decline. But if you flip that over, the flip side of price deterioration is increases in prospective returns. So now the prospective returns on many asset classes are higher than they were just a little while ago. And again, a much better climate for the bargain hunter.
Some people would counter this by saying inflation takes a lot of the value out of those returns, that basically on a real basis, you're still not getting very much. How do you counter that as a long-term investor by saying, you know what, at this point, it's worth it to get higher returns, even if on a real basis, it's not necessarily that much more?
Well, you're right in that we're not talking about an increase in real returns. We're talking about an increase in nominal returns. Most pension funds and other organizations reckon their need for return in nominal terms. But that is a challenge. And nobody knows what inflation is going to do. I think I heard out of one ear your previous guest say that some of the inflation factors will probably subside in the next few months, which means, all things being equal, an increase in real returns.
How much are you trying to game out where inflation is going to go over the next 6 to 12 months, considering the fact that I know that you do not time the market or look at a sort of day-to-day price swing kind of issue, but this really does determine how important some of these returns will be going forward?
Yes, it does, but I don't think there's anything to be known on that subject, and I'm sure we don't know it. And another tenet of our investment philosophy, there are only 6, we're going to touch on 2 today, is that our investment decisions are not based on macro forecasts. Macro forecasts are very important. The only problem is they're rarely right. And more importantly, any one forecaster is rarely right more often than the others. So we don't make our decisions on that basis. We are what's called bottom-up investors. We invest on the basis of micro, not macro, companies, industries, securities, and we feel there, through hard work and skill, we can get an edge.
So where are some of the industries, some of the areas that you're actually seeing deep value?
You know, they are much more spread around than they were before. You know, some growth names are offering much better value than they did a year or two ago, down 70%. But, you know, we continue to find opportunities throughout the investment universe. You know, the prosaic industries are also offering good value.
When you talk about the global investment picture, I know over the years, especially as the U.S. yielded less and less and yet less in real terms and in nominal terms, you looked overseas, in particular to China, as a potential area of prospective return. Has that changed as yields have gone up in the U.S. and, frankly, the economy has slowed so substantially in China?
Well, on the one hand, we have a preference for investing in the U.S. You know, the U.S., in most regards, has the best economy in the world, and it has an excellent environment for rule of law, for being able to predict the outcome when various stakeholders' rights come into conflict. That's very important to us, especially you mentioned our business in distressed debt investing. That's very important if you're going to buy distressed credits, to be able to predict how we'll be treated by the law. On the other hand, from time to time, other parts of the world offer better bargains. We have the best in the U.S., but the best usually doesn't come cheap. So, and on the third hand, we like to have some diversity in our portfolio. So, you know, we've been investing in places like China and India in the last couple of years, and absolutely will continue to do so. When I hear people say, you know, I've made my living for the last 50 years investing in the things other people said were uninvestable, high-yield bonds, distressed debt, emerging markets in '98, et cetera. And when I hear people say that China's uninvestable, to me, uninvestable says maybe there are some bargains there if everybody else is boycotting that sector.
How fully invested are you? Are you always fully invested?
We strive to be fully invested. Again, we're not market timers. Market timers say, well, right now we want 20% cash. We strive to be fully invested. Our clients hire us to invest in our asset class, not to time the market. And again, if better bargains arise, I'm always confident that we'll be able to raise more money to take advantage.
About 3 years ago, when we were talking about what prospective returns seemed plausible or realistic on some sort of safe or reliable basis, you said 5 to 5.5%.
You have a good memory.
Where are we now?
I think we can make 7 to 7.5. I mean, I'm not talking, I'm saying an institutional portfolio. At that time, I was talking for the Metropolitan Museum of Art, where I chaired the investment committee, and I talked the expectation down to 5.5, as you say. Or I think we came out I think the committee as a whole came out at 6. Today, I think an institution like the Met or another pension fund, endowment, et cetera, can make 7, 7.5. Of course, you have to be willing to go into alternatives to do it, but most people are willing.
What kind of alternatives?
You know, the big classes are private equity, private debt. Then there's distressed debt, there's real estate, and specialized forms of investing. The important thing is not which sectors. The important thing is which manager. You know, in the public asset classes like stocks and bonds, we call them beta markets because most of the return is determined by the performance of the market. And which manager you have means a little plus or a little minus. In the alternative markets, there isn't that gravitational pull toward the market return. There's no really market to pace it. What really matters is whether your manager is highly skilled and disciplined or not. And that's why we call them alpha markets, skill markets.
Do you think that your peers are taking undue risk or not enough risk?
Some of each, of course. There's a disparity. You know, there's a range, and all peers do different things. The point is, an area like private lending, where we're very active, has been a darling in the past decade. A lot of money and a lot of managers and a lot of funds have moved into the area. Buffett always puts it best. When the tide goes out, we find out who was swimming without a bathing suit. When economic and financial conditions become more difficult, we find out who made good credit decisions and who made bad ones. We'll see.
What's the historical precedent for this moment?
For this moment? Oh, you know, it's very hard to find one that fits exactly. You know, we've never had this externality of the pandemic. There hasn't been a war going on in a long time, an important international conflict with the threats this embodies. The U.S. never had an economic rival like China before. We never really had an economic rival since World War II. And of course, we have historically low interest rates. We had interest rates went down by what we call 2,000 basis points. That is to say 20 percentage points from 82 to 22. And that was a big tailwind. So these conditions are not reminiscent of any that I've lived through. But I think the important thing for your purposes and hopefully your audience's purposes is that I think that our taken as a whole, I think conditions are fairly normal today in terms of how you should manage your money and the risks you should take. And to me, that's the key decision.
Howard, thank you so much for taking the time. Howard Marks, the co-chair and co-founder of Oak Tree Capital. Tom, honestly, fascinating to hear how much some of the pessimism of today that we hear from so many people translates, frankly, into more optimism than a long time, simply because there finally is yield. There finally are opportunities, and finally there is not some monolith of optimism out there.
It's really old school, but it's also old school with a superb excess return over the years. And what's so interesting there, Lisa, with your conversation with Mr. Marks is the idea of a lifting up of the actuarial assumption. This is the Metropolitan Museum of Art. And Lisa, I'm not there yet. If you have a 5% assumption, when do you tick it up to a 7% return? Howard Marks is the first person I heard that from.
And it's frankly when you're starting to see that as the average yield on a lot of these instruments. So if you lock it in, if you believe that these companies are not going to default, if you believe, and you can get into the whole idea of whether the Federal Reserve has killed the credit cycle and whether we're not going to get the same slew of defaults in the same kind of way, this is what more people on the edges are talking about.
That's what Deborah Cunningham said at Federated as well, pushing against Ray Dalio. And she makes clear cash is not trash, and even at the short-term view where she is, basically full faith in credit, there's finally some value there. And that's something Howard Marks or any of us haven't seen in, I'll say, 15 years.
Yeah, suddenly, perhaps this isn't the end of a bond bull market, but if it is that actually really positive for bond investors?
Well, you pull back and you go price down and yield up. This is a huge topic at Davos. There's a point, where do you step in? It's no different than the courage to step into equities.
Yeah, honestly, especially when you do the credit analysis. We're getting a nice lift. That's what John says. Yeah. A nice lift to equities. I think it's interesting, especially given the uncertainty and yields higher, that there can be that sustained gain.
And the VIX, 25.94. Please stay with us through the day on radio and television. This is Bloomberg.